I think now we are on. Yeah, welcome everyone. Hemant, you want to start the session with the welcome comment?
Yeah.
Manish,
So,
Hemant, to welcome. I sent you biodata of Vivek. You introduced.
Sorry for that.
you need to introduce this, today's forward for.
Yeah, so if you can allow me the screen share, I can put the cover slide.
Yeah, I will do that. Just give me a moment. You have the right now. Please go ahead. Hemant.
Yeah, is the screen visible to everybody?
Yes, brother.
Yeah.
Yeah.
Hi,
Shall we?
Hemant.
Yeah. So, a very warm welcome to all participants. Myself, Think Tank Hemant Mehta, Think Tank Multidisciplinary Global Platform Chapter Leader, welcomes you all to this Think Tank Global Conclave for India Growth Story and Meet the Expert Series, covering in detail management think tank, valuation think tank, IBC think tank, financial think tank, and almost all the aspects of financial gamut or financial services which are being covered in think tank. As a major part of think tank at the rate Vivek Patra, Vivek in Sanskrit means knowledge and wisdom. Patra is an innovative news update containing slides on sharing latest uh, development and real life example by CEO, CXO, CFO, specialists, and professionals with global experience. Today we have Think Tank Multidisciplinary Global Platform special meeting for all stakeholders in finance, corporate affairs, industry, and profession. Think Tank has been in existence since over a decade. Idea conceived somewhere in January 1991 to have conferences, conclaves with CEOs, CXOs, CFO, panelists, and specialists sharing experience and real life example. Our panelists are financial leaders working in reputed companies or professions since many years and have deep domain knowledge. Think Tank platform now digital has got a overwhelming response globally on digital medium and expanding rapidly to LinkedIn, Facebook, etc. Our participants and experts have rich experience in industry and profession who have already holding the professional degrees like CPA, CFA, CA, CS, CMA, ISA, ISA, IFRS, BTech, Masters, PhD, etc. Uh, who are sharing experiences and knowledge and wisdom, spreading as a reach out initiative globally. You can visit our website www.thinktank.co.in. Due to overwhelming response to our annual report, uh, corporate strategy, and ESG, we have announced 6P awards and recognition. 6P stand for profit, people, planet, professionals, promoters, and platform. So this 6P award for corporate annual report analyst, professional achievers, CEO, CXO, CFO, with a very respected jury with rich experience in interaction with stakeholders and board. Uh, these recognition and awards would be announced with a rigorous process of scrutiny and choices and interaction with the participants and will be given digitally and if possible in well-located auditorium in Mumbai like Yogi Sabhagriha or some similar kind of venue subject to pandemic rules. As participant, are you aware that recently we have launched a much awaited referencer, a type of newsletter titled as Think Tank @ Vivek Patra, India Growth Story, a comprehensive conference material compilation over 600 pages, sharing experience by CEO, CFO specialists with latest development and series on blockchaining, regulatory fraud, financial reporting, NDAS, IBC, taxation, digital capital market, technical analysis, ISA, bank audit, corporate affairs, and will be available for subscription and any ethical contributions by valuations, etc. We will also be covering important and latest development as suggested by many participants in coming weeks. Example, valuation and financial modeling, health is wealth, cyber security, blockchain, MSMEs, etc. We request all to subscribe to Think Tank YouTube channel for watching summit, conclave, webinars, and join, connect, and network on Think Tank webinars group on LinkedIn and Facebook pages, Telegram channels, specially created on suggestion of many participants and panelists. We once again welcome all participants and panel members to share their few experience on this platform. I especially thank my colleagues in digital global team, Anupam, Aditya, Ajay, Anurag, Archana, Ashwari, Mitesh, Mihir, Malvika, Nipun, Nishchal, Pramod, Praveen, Rakesh, Sutya, Pramod, R. Kanan, sir, Manish, Santosh, Subrat, Nehal, Sandeep, Umesh, Vijay, Vikas, Yogesh, and others for regularly contributing to Think Tank @Vivek Patra. Today we have an excellent Think Tank multidisciplinary platform seminar with eminent solvers and specialists sharing experiences and latest development. Let us have an interactive event. So with this, I request Manojji to carry over to you, Manoj.
Thank you very much, Bhai. It is indeed a pleasure and privilege for me to be with you all in this excellent conclave, a pre-budget conclave. It's a very, very important time. Budgets have been used as a turning point by the government, union government, and the finance minister. Budgets give lots of hopes of changes, amendments, policies, which sectors will become more important, which will be encouraged, which sectors will be taxed more, collection of taxes, expenditure, FDI, divestments, and incidentally, we have seen last few years a turning point in the India growth story. Sectoral rotation, churning, huge investment, PLI schemes, incentives are becoming more and more important, and much more are valuations. What's the price we pay? So as a part of the series, wonderful session, more experts joining us. Manish, I would request you to share a few words about Mr. Vivek Mavani, who is sharing his rich experience, thoughts, and knowledge on the stock selections, valuations, methodology, criteria, and tools for various sectors with real example, latest developments as a part of the regular series. I would like to inform everybody today this is a pre-budget session. A few days later on 1st February, there's a lot of expectations from the finance minister, a special session with experts, the best in class on 1st of February, 5 to 8 special union budget think tank, deep dive on capital markets, income taxes, direct taxes, indirect taxes has been planned as usual every year. And we expect a full house. Kindly inform all your colleagues and friends, professionals to join in a much, much bigger way, deep dive into insights and interactive sessions on valuations, markets, stocks, global perspectives, IPOs, lots of things ahead. Yeah, Manish?
Thank you, Manoj bhai. Today we have a lead speaker, Vivek Mavani. Vivek is active in Indian equity markets with a fundamental analysis ideology for past 25 years. He was a research analyst, portfolio advisor, portfolio manager. He was head of PMS at 3 companies, and he has worked for a New York-based hedge fund as well as London-based FII. Last 8 years, he is advising wealthy investors and family offices and new corporates on investments and financial matters, including fundraising. He is SEBI registered investment advisor, and specifically last 25 years, he has met few hundred corporate promoters, management, and read thousands annual reports, balance sheet, and worked on financial analysis and valuation of many companies. So let's have an interactive session with Vivek. He has a rich experience and he will share his all thoughts about how he picks up the companies for investments and with real life examples. Vivek, welcome to you. Please start your presentation.
While Vivek is starting the deep dive presentation, a few more thoughts about Vivek. Corporate governance is becoming more and more important for getting the richer valuation. Or companies where the valuations get better down and even sometimes overnight is due to corporate governance. The board of directors, independent directors, the quality of independent directors is becoming much more important. And not only the quality of audit independent directors, their knowledge, experience, but the responsibility they have. They should not resign at the wrong time when they are required most. Vivek Mavani has interest in corporate governance since last so many decades I've been knowing him. And his main keen area is to improve the governance. And he is eligible. He has done the corporate governance criteria, qualifications prescribed by the IICA, Indian Institute of Corporate Affairs. And he can contribute to many, many boards, right, Vivek?
Yes.
Not only that, Vivek is a familiar face on most of the top business channels. You see him very, very often contribute his insights on latest developments, sectors, and companies. And his thoughts are very well looked forward to by many. All the top channels, business stories, and the corporate developments covered for India growth story. Yeah, Vivek, you're ready to share your experiences, knowledge.
Yes. So
dive.
Thank you, Manoj bhai, Manish bhai, and the entire team at Think Tank series. I would say a very, very, very good initiative to get fellow professionals on a same platform, sharing knowledge, experience, insights, wisdom, and all of it without any vested interest or motive, all of it only for service for fellow professionals. I mean, which is what is the most important thing, that it's all of it is free. So thank you, Think Tank team, for giving me the privilege of having me here today on this Saturday morning. Good morning, everybody, and thanks everybody. Almost 100 exactly. I mean, I see 100 participants, so 99 participants are excluding me. 99 participants enthusiastically logging in on Saturday morning. Thank you, everyone, for this. I hope to make this presentation over the next 1.5 hours enjoyable and memorable, sharing my experiences, observations over the last 25 years of being a market participant in the Indian equity markets. So a standard disclaimer that this is actually only for knowledge sharing and education purposes. No stock recommendations are going to be given out. Opinions will be shared, but opinions are not supposed to be taken as recommendations. And every participant is supposed to do their own due diligence and consult their financial advisors, brokers, chartered accountants, or whoever. So starting with paying respects to three stalwarts of the financial markets in the last 100 years, Benjamin Graham, John Templeton, and J.M. Keynes. The one on John Templeton, of course, is pretty controversial. So let's start with some fun. Markets are like women, always uncertain, always commanding, and always mysterious. So anybody who says they understand markets is either doesn't know the markets or is clearly not being honest. And Keynes, who's been more known for his economic theory, has also said something about the market, that markets can stay irrational longer than we can stay solvent, or where and a lot of value investors probably have been thinking globally that markets have been irrational in the last few years. So probably that is why special tribute to Keynes. So in the short term, markets are driven by liquidity and emotions. One feeds the other, creating a vicious circle. Here, emotion, we are referring to optimism and euphoria, hysteria, and so on and so forth. In the long term, markets are driven by earnings and only earnings. So while markets will be irrational in the short term, that irrationality self-corrects itself over the long term, and that is what gives us opportunities as investors, whether on the positive side or on the negative side. So this is the index in terms of the topics that we will cover. I mean, it's pretty extensive, so I hope to cover as much in detail. There will be few parts we may have to rush through for time constraints, but of course, Manoj bhai, Manish bhai, you can guide me as to how far we can go and how much deep we can go. If you think we need to shorten, there are things that we can go faster and skip through also.
Vivek,
yes,
what we suggest, you go at your normal pace. Don't rush through anything. Absorption is much more important, and it's a part of a series. So each topic, a deep dive at your own normal pace.
Yeah, sure.
Don't rush through anything. Don't rush through anything.
Yeah.
We take each subject is very, very important. We can do as a series, and we'll have this series every month integrated with stocks and sectors.
Okay, sure. So I'll go ahead. Why do we do valuations? So now we're paying respect to the Warren Buffett, the great price is what you pay, value is what you get. I mean, one line rationale for doing a valuation. Basically, it is about perception that markets are inefficient in the short term and make mistakes in assessing value. But the assumption is that those inefficiencies will certainly get corrected over a period of time. And it is these inefficiencies that give us opportunities to profit in the interim. So interim is whether it's medium to long term. In the efficient market, I mean, we have read and heard or studied efficient markets in our college as part of economics, and there's also been an efficient market theory a few decades back. Some great people have proposed. But where the market price then is the best estimate of value, because then there is no difference between value and price. That's what efficient market is about in a layman language. So then the purpose of doing any valuation is the justification of that price and value. I mean, you just need to justify each other. So, but in real life, efficient market does not exist, which is why we need to do this. So some valuation myths that we just get over. The valuation is an objective search for true value. Well, it's not really true. All valuations are biased. The only question is how much and in which direction. So whether the bias is negative or the bias is positive. The direction and magnitude of the bias in the valuation is related to who's paying who and how much. So if I may draw a recent example, a very high profile IPO which came, Paytm. So even although the IPO was priced at 2,100 something, the management, according to the management in their public statements at the time of IPO, they said we are leaving value on the table and we could have priced it much higher. So obviously the issuer in terms of seller of the stock or the company management and the promoters think that even at 2,100 it is undervalued and there is value left on the table for investors. Investors obviously had a very different opinion, both from at the time of applying for the IPO, which barely subscribed meaningfully, and the results are there for everyone to see in the last 1 month itself. Issue was listed at a discount and subsequently has just been going down. Now it's like more than 50% lower than the issue price itself. So, which is what we are referring to the bias. That investors certainly have a bias which is not in agreement with a hugely positive bias of the company and the management or the promoters. Good value. So the second myth is a good valuation provides a precise estimate of value. So that again is not true. The truth is that there are never any precise valuations. This is not physics or mathematics, actually speaking, although we use principles of mathematics and so on and so forth, but that is not what this science is about. The payoff of the valuation is greatest when the valuation is least precise. So in the sense, more the approximations, more the assumptions, greater is going to be the precision. For example, because my assumptions could be different than your assumptions, my perception could be different from your perception. That is what gives the opportunity in the market, where there are millions of other market participants also thinking differently, and which is how the price gets determined with trading every single day. The third myth is the more quantitative a model, the better is the valuation. I mean, that seems to be the belief that the more formulas, the more Greek alphabets, alpha, beta, and jitna zyada mumbo jumbo, jitna zyada jargon used here, better is a valuation model. Well, actually, it's not true. One's understanding of valuation model is inversely proportional to the number of inputs required. Inputs is the variables that we are talking about. Simpler valuation models do much better than the complex valuation models. And we have seen that during the global financial crisis, where the Wall Street banks and all of them had complex valuation models to value their portfolios, which all turned out to be all humbug, because market was clearly saying something else than what their financial models were reflecting. So what are the valuation models? So there are three categories actually. One is relative and multiple based valuations, which are based on earnings, sales, or book value. So they are either based on items in the P&L account or balance sheet. The second is asset based, which are largely about replacement cost or liquidation value. It's largely about the asset side of the balance sheet. And the third is discounted cash flows. I mean, it could be free cash flows, it could be dividends, or and so on and so forth. So all valuation models, whatever you use, will be in one of the three categories, or it could be combination of the two as well. And as we go along, we'll come to the details. So most commonly used multiples are P ratio, price earnings ratio. All of us keep talking about it day in and day out. Price to earnings, which is a variation of earnings itself, whether you take earnings as profit after tax or net profit, or you take cash earnings in terms of cash profits. It basically is a variation of the same thing. Price to book value, earnings yield, which is you invert the P ratio 1 divided by P, so that you can compare it to interest rates. Market cap to sales, or enterprise value to sales. Enterprise value, for those who are not familiar, is market capitalization of the company, which is a value of all the shares issued by the company into market price. That is market capitalization. Enterprise value is the net debt of the company. So that enterprise value assumes that if you had to buy the company with all its liabilities and all its debt and borrowings, what is it the number that you need to pay? So enterprise value to sales. Variation of all the enterprise value is EV by EBITDA. EBITDA is your operating profit, which is earnings before depreciation, interest, tax, and amortization, which is your operating profit from, or it could be EV to cash profits. It could be market cap to cash flow. You can take EV to cash flow. All of them basically are about payback. As I said, market cap or enterprise value is that if you had to buy out the entire company, and after you become the owner, how many years will it take for you to recover your investment? From that point of view, how many years of profits, how many years of cash flow will pay back your investment? There could be many variations of the above. As I said, I mean, each of them will take some item of the P&L account as a denominator, whether it is cash profits, EBITDA, so on and so forth, or sales itself. What is important with the ratio is that it should be relevant, number one. And it should be used consistently across time frames and across comparatives. Comparatives is when you compare one company with the other, or you are comparing one company with what is the same for the sector or for the broad market. I mean, it should be relevant. So you need to compare them on the same platform. It's not that I take a P ratio of one company and I take cash earnings of second company, and for a third company I take book value and then make conclusions about it. So what are the advantages of using relative based models? They're fairly easy to understand, compute and comprehend. So when I say they are easy to understand, I mean, कोई बहुत ज़्यादा complicated formula है नहीं. There's price on the numerator, which is the market price, or denominator has the earnings, or you have cash flow, or you have the cash earnings. It's easy to understand, it is easy to compute, and it is easy to comprehend. So if I tell you that the P ratio of Nestle is 80, I mean, I'm sure everybody is going to understand it much better, versus if I say the DCF value of Nestle is 24,000. So the next question Manoj Bhai is going to ask me, Manoj Bhai is a chartered accountant, he says, what is the growth assumption? What is the discount rate? What is the cost of capital? How many years of discounting have you done? So I mean, that for me to justify that 24,000 DCF value for Nestle, his thought and my thought may be different in terms of growth rates, in terms of cost of capital, in terms of discount rate, in terms of interest rates, and so on and so forth. These ratios don't have that problem. I mean, they're easy to understand, compute and comprehend. They are very versatile. They can be applied across most asset classes. They can be applied across most sectors of the in the market. They basically follow a very basic human nature to compare and set benchmarks. I mean, it's inherent human nature. We are hardwired genetically that we will always make comparisons of everything. We'll make comparisons of everything. So, but there are obviously shortcomings to everything. They are all very subjective and relative. All these ratios are pretty subjective and relative. Since not all factors concerning valuation are captured in numerical terms, because they only capture one item, which is earnings or cash flow. Each of those ratios has basically only one item in the denominator. They do not capture the whole picture. They are like a freeze frame in a movie. So if you're watching a movie or movie pause kar diya, so the screen, the screenshot that you get, that is what your multiples are. आज P ratio ये है. Monday it may change depending on what the market will do on Monday. Each of those multiples also has its share of shortcomings due to accounting issues. We'll come to the accounting issues later. And since we have a lot of friends who are CAs, they will also help us understand as to why we have these accounting issues with companies. I mean, I have argued this with several CFOs over the years as to why accounting cannot be standard in terms of which should ideally make the job of everybody easier to understand the P&L account of the various companies. Anyway, so we'll take that separately. All of these multiples are easy. They're easy to understand and all that, but they still don't necessarily tell you whether an investment is cheap or expensive. So if I tell you the P ratio of Tata Steel is 10, last year it was 20, it still doesn't tell you anything. That last year at 20 it was attractive, and this year at 10 it may probably not be attractive. So it still doesn't tell you that number, whether it is cheap or attractive. Marico has a P ratio of 40 and Nestle has 80. That still doesn't tell me कि Marico सस्ता है, Nestle महंगा है कि क्या है. It still doesn't give any conclusive answer on anything. Okay, so what is in favor of? I mean, if there are shortcomings, and why are they so widely used? Fact of the matter is 95% of research reports globally, whether it is consultancies, investment banks, brokerage reports, investment reports, everybody uses 95% of reports use these ratios. More than 50% of M&A transactions happen where valuation is based on these multiples. One of those multiples, not necessarily P ratio, but one of those multiples. All of those ratios are subjective and relative, but most business issues, whether in terms of expected growth rates, management quality, brand equity, they are all also subjective. I mean, who is to say that a brand equity of Nestle is more than the brand equity of Marico or Dabur? All of it is subjective. So life also is very subjective, and life also is nuanced, and that is what we are talking about. So what one does is, as professionals, we make accommodation for positives and negatives. You weigh the pros and cons of the asset or the security that we are evaluating. There will be biases and errors, no doubt. I mean, our thinking is full of bias. I mean, let us admit that very honestly and candidly, all of our thinking is biased. To avoid a static picture, all of these ratios can be suitably modified to make peer group comparisons or even historical comparisons. So historical comparisons could be as to how these P ratios have evolved over a period of time. That okay, Nestle is at. I keep coming back to Nestle. It's one of my favorite companies. Is at maybe 80 times earnings today. Was it 80 times always? You can look at long-term P bands of Nestle. Look at EV by EBIT of Nestle or price to book and so on and so forth, and see that, oh, it was not always that way. It used to earlier trade for many years between say 30 and 40, and it's only the last 3, 4, 5 years that it's been trading at 60, 80 times or 100 times. So it still gives you some fair idea in that sense as to how these things evolve. But the movie kaise chalta hai? We are not watching a screenshot of a movie. We are obviously going to be watching a movie. So how do we put them into practice? So you take the earnings to start with, excluding extraordinary items and one-time items. Extraordinary items could be write-offs, a company stake, or one-time items could be sale of business unit or a sale of an asset and all that, which doesn't happen every year or doesn't happen frequently. So you take the core earnings from the business. Starting point always can be the most recent financial year, or it could be trailing 4 quarters. Last 4 quarters, it solves the problem of differences in year end. I mean, we have some companies who have, most companies of course have March year end.
200 rupees, minimum 200.
Yeah, can I request muting whoever's phone is or computer is on? Yeah, sorry. So trailing 4 quarters solves the problem of differences in year end. It also allows us to do mid-year. I mean, right now we are in January and third quarter results of a lot of, I mean, all companies that are coming out. So you take the last 4 quarters, because taking last financial year, which is like 10 months old number, is also not very relevant. It can be a starting point, but it cannot still be the number to work with. And on that, you take the expected near future, which is next 2-3 years of expected earnings growth, as to what we expect the earnings or what we expect the EBITDA to be, or what sales growth we expect to be. And that's probably the starting point, and that's probably what will give us the denominator, whether it is the earnings or cash profit or the sales number. The numerator always is going to be your current market price, and whether you take market cap or you take enterprise value, it has a base in the current price itself. So what we need to work on is a denominator. Numerator to market hi de raha hai. Every day market is itself giving us the numerator. So comparables should exhibit similar growth, similar business characteristics as regards growth, risk, and cash flows. So when I say comparables, in the sense when I'm comparing a peer group, so if I take Ultratech, then Ultratech has a P of 40 times. Can I compare it to Tata Steel, which has 10 times? Well, obviously not, because growth of a cement company like Ultratech, which has operations all over India, is fairly different from Tata Steel's business, which is global in nature, where substantial part of the earnings, I mean, sales and profits and earnings come from outside India. So obviously growth, risk, and cash flows as regards the business are very different of a cement company and a steel company. So you obviously can't compare it, but you can do compare Ultratech with other cement companies. You can compare Tata Steel with other global steel companies. No, I mean, I'm not restricting this Tata Steel comparison only to a Jindal Steel or Steel Authority, but I'm looking at global comparisons because Tata Steel itself is a global company. So comparables can be historic. I just touched upon it a couple of minutes ago, that you can compare it to the same company historically. What has been the value multiples that a company has been trading at, and why has it gone up or gone down? Understand that. Peer group could be international comparisons. I just mentioned about Tata Steel being compared to other global steel companies. or one can simply compare it to Sensex or Nifty. I mean, it's like pretty okay, but again, Sensex Nifty itself is a weighted average of the respective constituents. I mean, the 30 or the 50 constituents. We need to accommodate for deratings or re-ratings that happen. We'll come to that in a while. So what are the issues with these multiples? I mean, the issue is always with the denominator, because something that we mentioned, inconsistencies across financial years, which results in restating of earnings. Often the P&L account of 2 years can't be compared because accounting standards do change. I mean, from time to time, some companies adopt Indian GAAP, some companies have, so some of the Indian tech companies have US GAAP, and that's how they report. I mean, but as long as the peer group has got the same accounting standards, I mean, then it's fine. But otherwise, you do have these kind of issues which are very common. Substantial portion of value is derived from expected future growth, which not only is highly uncertain, but is very, very difficult to predict. Now, given the disruption because of technology in most sectors and businesses, corporate life cycles are shortening very fast. So, I mean, earlier one could predict that this company will be in business for 50 years and will continue to grow at a certain rate for the next 20 years. I mean, it was once upon a time, one could make those assumptions. You can't make those assumptions today as easily, whether a business is going to survive so long and continue to keep growing at a certain rate. That's very difficult. So just to give an example, OTT platforms, I mean, your Netflix and Amazon Prime and your Z5 and Sony Live and all of those media streaming platforms via the internet is obviously disrupting the television and cinema business, because earlier entertainment meant you watched a movie on the television or you went to a theater or multiplex and watched a movie. Now you can watch movies on this, which basically is denial of business to television and television channels and the multiplexes. I mean, so there is a shift. I'm not saying that these businesses will not grow, but from a consumer spending point of view, some part of the spending of a consumer on entertainment is going to a new platform or a new players in the market, which otherwise could have gone to the traditional cinema and the television businesses in terms of subscription revenues or ticket sales or so on and so forth. Print media is a very prime example. In the last 20 years with the advent of internet, that print media not only has stagnated, has declined by size in terms of revenues and profits in most parts of the world. I mean, the very habit of reading reading a physical newspaper is a habit which is the younger generation is not even having. At least I and probably a lot of our colleagues over here, we do have a habit of reading a newspaper, but it may not go on for a very long time because newspaper clearly is inadequate. I mean, we need to have more news from online sources, and which does put a question mark on the survival of the print media, but certainly growth is a question mark already. Survival is also a question mark in the next 10 years or so, next 10, 15 years. Another issue that we have is accounting statements reflect the past, what has already happened. We make investments always for the future. So as a result, what the issue that we have is financials are substantially low. I mean, profits will be substantially low, and hence multiples will be very high for companies which are in high growth phase or high growth sectors, or traditional companies which are in the process of expanding capacity substantially. So if you look at the current earnings and say, oh, this company seems so overvalued, I mean, it's trading at very high multiple, that's what it may seem visibly, optically. But then suddenly if somebody told you, oh, it's doubling capacity and the earnings will become 3 times in the next 3 years, suddenly it doesn't look very expensive. It looks very sasta, because market obviously is discounting the future. Market is not discounting the past. So one has to make accommodation for these kind of issues that one faces in real life. So we come to what are the factors that drive these ratios? Why do certain companies get a higher discounting than others in the same sector in spite of similar business dynamics? So if I may compare, I mean, all of us are familiar with the tremendous wealth that Bajaj Finance has generated or created in the last 10 years versus all the NBFCs on the other side. And I'm actually using the word all other NBFCs because there was a very nice graphic somebody had forwarded me, that market cap of Bajaj Finance, you put it on one side, the market cap of all other NBFCs, all other NBFCs, and it's more or less equal. But like one Bajaj Finance is equal to the rest of the NBFC sector, which probably includes 30, 40 companies or 50 companies. I don't remember how many companies were compiled, but all your big, large names were there. And we noticed that Bajaj Finance in the last 10 years has traded very high price to book multiples. Maybe, I mean, at the lowest point, it would have been priced, 6 times price to book. High at this point of time, it is close to 10, 9 or 10 times price to book as we speak. While all other NBFCs, look, I mean, all of them are like, I mean, for example, Aditya Birla Capital, very well known, trading at 1 time or maybe 1.5 times price to book on a consolidated basis. Mahindra Finance trading at maybe 1.5 range. Shriram Transport Finance again, maybe 1.5 times. I'm just giving approximate numbers. But you do get the flavor of what I'm saying. Why is it that Bajaj Finance always has traded at such a huge premium versus all other NBFCs? Finally, all of them are in the same market, probably lending to the same set of borrowers, and their source of funds is also from the same set of investors and banks, or same set of investors who are buying the bonds and debentures of all of these NBFCs. So why does that happen? And yet, even at 8 or 9 times price to book, Bajaj Finance is attractive, looks attractive, but Shriram Transport Finance at 1.5 times price to book doesn't look attractive. I mean, why is it that? Another question that bothers most investors is that why do certain sectors as a whole, get higher or lower discounting than others? So cement and steel, both are cyclical. Obviously, I mean, it's a foregone conclusion. We are not arguing that. But most cement companies, I'm not just referring to an Ultratech, but even an average cement company has higher multiple than an average steel company. So, I mean, if you compare their tier 1 to tier 1 or tier 2 companies in both sectors, cement companies generally have higher multiples than steel companies. Why does that happen? I mean, I'm sure a lot of this question would have crossed the minds of a lot of market participants and investors. Why do re-rating and de-ratings occur? What drives this process? So re-rating is when multiples expand. De-rating is when multiples contract. And this re-ratings and de-ratings contribute substantially to investor returns. To give you an example, that ICICI Bank, for example, was trading at 2 times price to book 2 years ago. Today it trades at more than 3 times price to book. So assuming that in the last 2 years, assuming the book value of ICICI Bank had remains constant, the journey of the stock from 2 times to 3 times price to book itself has given you 50% returns from the ICICI Bank stock. But obviously, even the book value of ICICI Bank has gone up, which is why the stock has moved up from 250 levels to 700 plus levels, 750 or whatever levels that it is today. So that investor returns or the change in the price is a combination of change of your denominator, which in case either is a book value or earnings, change of the denominator, as well as change of the multiple. The multiple also went up higher. But why did it happen, or why do these things happen? And these things are very, very common. These re-ratings and de-ratings are very common. Practically every quarter there are few companies which are getting re-rated or de-rated, and we observe that. A very recent example was Hinduja Global, HGS, that IT company of the Hinduja Group, massively de-rated just in a matter of week for something that investors didn't like what the management did. All have their justifications. Nobody is right or wrong in this world. Everything is in a matter of perspective. So anyway, we look at why these things happen. So these are the relevant questions to ask, or relevant questions that come to the minds of market participants, and we need to find answers, because if you can find answers, that is where a lot of opportunities can be found in the market. So what drives these multiples is perceptions and how perceptions change and evolve play a very huge role in these multiples. And perceptions is all about the numbers of the company from the point of view of number one factor is growth. And growth itself has 4 dimensions according to me. Potential for future growth. So all of us obviously are investing for future. We are investing for growth. So we are going to invest in companies which are going to grow their earnings. And so obviously the perception of potential of future growth, which also takes into account, so it's not just normalized growth. In case of an FMCG company or a pharma, which are fairly mature businesses with deep penetration, it's largely about normalized growth, which is growth of population and growth of usage per person usage, and which is what will give you maybe a certain growth rate. But then there are growth dimension which gives you a step up kind of a growth, which are fundamental shifts which happen globally from time to time. A prime example in the last 2 years or 3 years is the chemical sector, where once upon a time it used to be considered a very capital intensive and a cyclical sector. Very few people would have been interested in the chemical sector. Suddenly, from a cyclical business, it is now a secular growth story, secular long-term growth story. Thanks to COVID and now global supply chains diversifying away from China. So China plus one strategy that we have heard in textiles, we have heard in chemicals, we have heard in pharma, we have heard in a whole lot of other sectors also. Suddenly your perception about future growth rate about Indian companies changes. That, oh, this company can probably, earlier your growth assumption is this company will grow long-term earnings by 15%. Suddenly now there's a lot more bigger opportunity. They can grow at a much higher rate. So that is what we are referring to as potential of future growth, which is why if you notice, all chemical companies which probably 10 years ago were trading at 5 to 10 times earnings suddenly are at 30-40 times earnings, because the growth rate expectation has changed. Second is, it's not just growth rate, it's the quality of the growth rate. So somebody may say, hey, quality kya hota hai? Growth to growth hota hai. No, but I'm adding a dimension to that also. So I'm giving an example of ITC. So ITC, 80% or 85% of the profits come from the cigarette business. Cigarette business earns a return on capital of maybe 70%. But if you look at the capital allocation of ITC, the cash flows of the tobacco and the cigarette business are being reinvested in capital intensive business of paper and hotels and other business, which generates return on capital of 10% or 15%, not even 15%, 10% is more normalized return on capital. So basically from a higher business which has profit margins of 30%, you're investing in a business which has 10% profit margin. I mean, the cash flow is being diversified there. And from the business that gives you 60% return on capital, you're investing in a business that gives you 10% return on capital. I'm not saying ITC mein growth nahi aayega. Growth aayega. What is the quality of the growth? I mean, it's significantly inferior quality growth that we are talking about if it was a pure cigarette company. Third dimension of growth is sustainability. How long will the growth go on? I mean, it's not necessarily the company has to grow at a very high rate. It's not enough that a company grows at 50% only for 2 years and the third year question mark is company growth whether the company will grow at all or not. So if I may draw a parallel, all of us are interested in cricket, all of us are passionate about cricket, not just interested. So it's not just enough that a batsman comes on the pitch or usne 3 chakka maar diya. A batsman hits 3 sixes in an over is very fun and entertaining to watch. But the batsman has to stay on the pitch and survive a long innings, because just hitting 3 sixes is not enough. He has to play a longer innings. It could be that longer innings could be without the 4s and 6s. He may make 1s and 2s, but he may still score a century. What would we prefer? We prefer a batsman who will stay on the pitch for a much longer time and contribute to the overall score, rather than just come there, 2 over खेल के 3 छक्के मार के out हो गया. Which batsman is preferred? Obviously, the one who's going to stay longer. So similarly, from the earnings point of view, companies which can deliver growth for a much longer period of time where the growth is far more sustainable. So which is where FMCG and pharma traditionally have had higher multiples, because the sustainability factor is not a doubt. I mean, whatever be the changes in technology, whatever be the disruptions in every business, all of us as humans, we still need to wake up in the morning and brush our teeth and have a bath and shave, and hence and have a cup of tea, and obviously breakfast. I mean, even if you just say, look at our morning routine of the first 2 hours, our interaction with at least 5 FMCG companies is taken for a shot, and it doesn't matter where. It did not matter. Even your grandfather had the same schedule, and even your grandson is going to probably have the same schedule. The companies may change. I'm not saying that the same companies will keep going on and on, but as a sector, the sustainability of the growth is much longer. Yes, there will be periods of high growth or low growth. Those are cycles, those are economic cycles. But nobody can deny that these companies will be out of business. But so a thought on whether a company will be out of business, Coal India. I mean, the amount of investments which are going into renewable energy and all that. A serious question, 20 years later, will there be thermal power, coal-based thermal power at all? So Coal India can say, oh, we have so much of reserves under the ground. So all of those billions of tons of coal underground will just remain there. I mean, zameen ke niche koila reh jayega, koile ke value nahi rahegi 20 saal baad, because there may not be at least in India, there are no new greenfield capacities of thermal power coming. So which means only the existing thermal power plants are going to use the coal from Coal India. Where is Coal India going to sell all that coal 20 years later? I don't know. Quite honestly, I don't know. मतलब वो कोयला तो जमीन के नीचे zero value हो जाएगा. Same way with the disruption happening in the electric vehicle space, all of the oil under the ground and under the sea everywhere will probably have a very fast erosion in value. Uska value ही नहीं रहेगा. Who needs that? Who will need that coal 20? Who will need that crude oil 20 years later? I don't know. Maybe there will still be a market, but maybe the market will grow at a much lower rate. I mean, the business of Coal India will probably grow at a much slower rate than it has grown in the last 20 years. The fourth dimension is consistency. Whether the company has got predictable and consistent growth rate. So there, obviously, say IT companies like, say TCS. I mean, quarter after quarter, year after year, TCS has been delivering about 18% to 20% growth rate, fairly consistent. And it's not 1 quarter, 2 quarter. I mean, you can the last 40 quarters, you can see, or last 50 quarters, it continues to keep doing that. And HDFC Bank, again, consistent growth quarter after quarter. Kotak Bank, again. All of this is contributing to the superior multiples that some of these companies are getting, or the inferior multiples that a Coal India or an ITC gets. Second dimension beyond growth is profitability and capital efficiency. Capital efficiency is also about capital allocation. That obviously a company makes profits, generates cash flows. What does it do with those cash flows? Does it reinvest for future growth? It gives out dividends and so on and so forth, or does nothing and just keeps the surplus funds on the balance sheet and runs a parallel treasury operation. So there are a lot of companies which have such sizable surplus cash on the balance sheet that the other income is a parallel line of business, actually running the treasury in terms of the surplus cash and bank balance and investments on the balance sheet. All of it obviously dilute the return on capital and return on equity, because there's only limited the treasury operations the surplus cash can generate. I gave an example of ITC in terms of capital allocation. Where is it going? Is the incremental capital investment generating commensurate returns against that? Or are you having a bloated, or is your balance sheet growing faster than your P&L account? I mean, if balance sheet is growing faster than the P&L account, obviously over a period of time, return on capital and return on equity are going to be having a downward trend. Third dimension is cash flows and free cash flows. all of us from an accounting point of view understand the P&L account, profits and all that, but all of us also understand that profits can be manipulated, profits can be adjusted, and all the jugglery which is possible to do, and which 90% of the companies actually do that jugglery. I mean, I can make that statement that there'll be very few companies who don't do the accounting and financial jugglery with their P&L accounts. But cash flows are very difficult to manipulate. You can manipulate your sales, you can manipulate your expense side, but cash flows as what in the traditional parlance, I'm in a Gujarati, and I was talking to Manoj Bhai day before yesterday. I was telling Manoj Bhai, I'm a Gujarati, you are a Sindhi, हम लोग तो रोकड़ा समझते हैं. Cash profit कितना है, cash flow क्या है, बाकी सब तो खाली कहानी है. Everything else is a story. What are the cash flows in the business? Are there cash flows in the first place? So, and we realized it, and often investors tend to neglect that or ignore that. So I'll give an example of, say, Future Retail. Future Retail for many years actually showed profits. It's not that the company was loss making, but it was a company that never had cash flows actually. So there were profits in the P&L account, but there were never any positive cash flows of a meaningful number. When I say meaningful, I mean a company of the size of Future Retail showing you cash flow of 5 crores is, I mean, it's hardly material there. I mean, it's a few thousand crore company by sales. So if not anything, the cash flows have to be at least a couple of 100 crores. Utna nahi hai, to where is all the profits going? All the profit, then you realize all the profit was in inventory. And the profits which you saw was actually only in inventory valuation if I remove all the jargon and if I remove all the accounting adjustment. That all of the stock and inventory which was there, which was all unsold, and all the cash was sitting actually with the inventory. It was not in the balance sheet as cash and cash equivalents, which normally one would have expected to see. Extension of cash flows is what dividends a company pays, and dividend payouts is basically how much dividends is paid as a function of net profits or profit after tax. Finally, we are investors. We know that when you're buying equity, you are a small partner or a small co-owner in a company. So then as a co-owner and a co-partner, you obviously need to have something take home as well. And as an investor, the only take home you can have is dividends. So what percentage or what part of the profits are being given out as dividends, and what are the dividends in absolute terms? So there again, if we look, and extension of dividends, of course, is also buybacks and all that, which is also indirect way of returning the surplus cash to the investors, which is where the TCS, the likes of TCS and all are very high. That not only are their dividend payouts very high, but every 2-3 years they are doing very large buybacks, and the surplus cash is being given out to the investors and shareholders. Interest rates. Now, interest rates, often people confuse, oh, but this is a debt-free company, so there is no impact of rising interest rate. Well, actually, it's not that. Interest rates determine the liquidity in the markets, or overall in the economy. So all of us in the last couple of months or last few weeks have been very curiously trying to make sense of what the various central banks globally, especially Federal Reserve in US and the European Central Bank, or even our own RBI, what is their opinion on interest rates? Are the interest rates going to rise? When will they rise? How much will they rise? How much will they tighten? So tightening is obviously about taking liquidity away from the economy, and when liquidity is tightened, obviously the liquidity will tighten in the financial markets as well. So that is basically the role of interest rates. We'll come to the role of interest rates subsequently when we do DCF, when we discuss DCF in the subsequent slides. So this last point, quality of the management reflected in the quality of financials, and the second and the related point is perception, reputation of the business and the management. There is a purpose why these are the last, although there's a most important point. There's a reason why it is not only last, but it also is highlighted in terms bold and underlined. Because if this whole slide was a structure, if for a building, the base of the building, the foundation is the quality of your management. which is going to drive your quality of the management, is going to drive your growth. Quality of the management is going to drive your profitability and capital efficiency and cash flows and everything else. And finally, perception and reputation of the business's market. What does the market and financial participants think about them? So if I were to say, what does everybody over here think about Vedanta and Anil Agarwal? I'm sure there will be fairly polarized opinions on that. We're not getting into that at this point of time. Or say PSU companies. I mean, what does one think of PSU companies? Okay, one thinks of inefficiency, corruption, and persistent loss-making companies, and so on and so forth. I mean, that generally, I'm using, it's a generalized perception. There are a lot of profit-making PSU companies also, but general perception of PSU companies, people don't rate it as very high. I mean, nobody will say, oh, the certain PSU has probably the best quality management comparable to an Infosys, TCS, a Bajaj Finance or HDFC Bank. ऐसा तो मेरी जिंदगी में मैंने कभी सुना नहीं है. So this is what drives these multiples. Multiples have a direct relationship, but not necessarily an inverse relationship. I mean, not a linear relationship, but they do have a direct relationship. So higher the growth, higher the multiples, higher the cash flows. I mean, multiples will be higher for growth, higher the capital efficiency, higher the profitability. We look at those with some actual examples also, or I could mention those examples as we go along. So continuing with the quality of management. So then, how does one evaluate the quality of the management? Because to say that this is a high quality management and this is a low quality management itself can be a very subjective thing, and it is about opinion. My opinion about a company and a management and a promoter may be very different from your opinion or anybody else's opinion. But obviously, management quality is what is going to drive all of those other things. Every item in the balance sheet and profit and loss account is going to be driven by the quality of the management, for the simple reason, risk can be managed with foresight, and here we are referring to business risk. Damage can only be controlled in hindsight. So if I may give an example, we have had some episodes which have not been very pleasant in the last 3-4 years. A Yes Bank had some serious problems. It needed to be bailed out by a group of banks who infused capital. And ILFS happened, DHFL happened. I mean, these kind of corporate accidents or frauds or whatever you may call it did happen. Whatever were the steps taken was all damage control. Damage control after the event happened. The band बज गया, उसके बाद अभी क्या करना है, अभी कैसे बचाना है? Because at stake is like a huge amount of money of the investors, of depositors, of a lot of people in the financial system. That is only damage control. But would you ever hear that an HDFC Limited, which is a company, which is an institution, been in business for almost 45 years, or an HDFC Bank, which has been in business for 27 years, or an Kotak Bank requiring any of those kind of external measures or external intervention by RBI or government? You never hear of that. Simply because those companies or those banks and institutions have very strong internal risk management systems and processes in place. It is not without reason that they have had the lowest non-performing assets in the system. How is it the HDFC Bank always has non-performing assets less than 3% gross NPAs and 1% net NPAs? I mean, 1 साल होता है, 2 साल होता है. People say, oh, these are economic cycles, economic slowdown. तो क्या economic slowdown HDFC Bank को नहीं लगता है क्या? HDFC Bank को भी लगता है ना economic slowdown. Or with a Kotak Bank. So how is it that these banks always have a very healthy balance sheet and or a Bajaj Finance has a very healthy balance sheet? People say, oh, Corona and lockdown and moratorium, फलाना ढीकना, तो क्या HDFC Bank के borrower को ये सब नहीं लगता है क्या? वो भी तो लगता है ना. Even their borrowers had a moratorium or so on and so forth, or they were delayed payments or delayed repayments rather. But yet, the net NPAs, or if you see over period, whether it's 1 year, 2 year, 5 year, 10 year, 20 years. I mean, they've always had low NPAs. They've always had high net interest margins. What does it mean? That they are pricing the risk of the borrower appropriately. That if a borrower is a high risk, quite simply don't give a loan to a high risk borrower. That's number one. Or if you do give it at a much higher rate that compensates in terms of higher net interest margin. That is what indirectly these banks are internally doing. So it is not without reason that a Kotak Bank or an HDFC Bank have net interest margins which are significantly higher than lot other banks. Or if you take all banks as an average, HDFC and Kotak Bank have net interest margins which are much higher, which is what indirectly is a reflection of risk management internally. Same applies for Bajaj Finance. Same applies for a lot of other good quality, high quality NBFCs. But then if you ask it, why did a Diwan Housing or an ILFS or a Yes Bank not do that? Well, because they didn't do it is why we don't say that they are good quality management. They are obviously inferior quality managements, and market has reflected those in terms of what the stock prices eventually became. A Yes Bank from 300 to 10 rupees, that is what is reflection of the management. So I have also indirectly covered why are some companies consistently more profitable than others, including the peer group, HDFC Bank versus other banks, but you can add Kotak Bank also. Why other banks? How is it that some companies always do better than other companies irrespective of macro environment? So how is we have mentioned of TCS in terms of consistency of growth rate, longevity of growth rate, but it's not 1 year, 2 years they are delivering 18-20% growth rate. TCS has been delivering 18-20% growth rate for the last 15 years. It was listed in 2004 or 2005. So we are talking about 16 years of quarter after quarter, year after year of superior growth rate than other companies. And not to say that this is no more a small size company. It's a company that is humongous in size. And a smaller company, a fraction of the size of TCS, saying, oh, the macro headwinds in US. I mean, I don't understand this. It's something to do with the management. I mean, why is it that they can't grow and TCS is able to grow? It is something about the internal processes. It is something to do with the internal organization structure. It's probably got to do with the quality of the people at the end of the day. Because when we say management is also people only, right? The next point, how is it that change of ownership of management results in substantial change in valuations, which all of us have observed, right? I mean, all of us have noticed that. And it does happen that, so what really is happening is the perception of management is changing with the assumption that because of the change in management, the previous factors in terms of growth and profitability and cash flows will also improve. That is what indirectly the market is reflecting, that the change of management or the change of ownership will result in higher growth rates, better profitability, higher cash flows, and higher return on capital and return on equity. That is what indirectly is being implied. Rightly or wrongly, I'm not making any comments. I'm not sitting in the chair of a judge and making judgments or making any, I would say, prescriptive statements. I'm only sharing observations as to what happens in the market and why do they happen. Why is it that a certain set of companies which have multinational parentage or foreign parentage have enjoyed higher multiples than similar companies domestically? So I gave an example. Why is it that a Nestle consistently trades at a premium? Nestle or a Hindustan Unilever or a Gillette or a Procter & Gamble consistently for 20 years trade at a significant premium to domestic companies like a Dabur or a Marico or an Imami, or you could name any other domestic consumer company. And if you look at the ratios, I mean, consistently over the last 20 years or 25 years, the foreign multinational parentage companies have traded at significant premiums to domestic companies. And by no means are the Indian companies or Marico or a Dabur anyway inferior in terms of growth rates, cash flows, return on capital, or nothing of that sort. I mean, even Marico has had or a Dabur have had a fantastic track record of return on capital of 25% for like 20 years. So it's not that they have inferior quality of financials. It's just the perception that market participants attribute to those foreign owned or multinational companies. So what is it that, I mean, driving these multiples? I mean, extension of that. All multiples have their roots in fundamentals. I mean, I mentioned that that when we say roots in fundamentals, all of that has roots in P&L account and the balance sheet, and a derivative of that, which is a cash flow, which has items from both the P&L account and the balance sheet. Fundamentals do vary widely across time frames and across different fundamentals. I mean, across comparables. When we say fundamentals vary, in the sense companies, even growth companies, companies which have delivered growth year after year, also go through phases of high growth and low growth. And it is part of overall economic cycles. I mean, you can't have a straight trend line going up at a certain trajectory. There will be periods of high growth, low growth. There will be cycles, and cycles are inherent part of nature. Just like we have seasons, winter and summer, and in between it rains and so on and so forth. Even the economic cycles are the same thing. So you do have seasonality and you do have cyclicality. Often, but what happens as a result? Often different multiples tell a different story of undervaluation or overvaluation. So a company which may be trading at 0.5 times sales, I'm just giving an example, I'm random example, no particular example, company. Now 0.5 times sales may look cheap because a lot other companies are trading at 2 times sales or 3 times sales. So either 0.5 times sales is sasta hoga. But suddenly if I tell you that, oh, this company is trading at 50 times earnings also, and it has a return on capital of 10%, suddenly the picture changes. It's not, doesn't seem cheap, but 50 times earnings with 10% return on capital doesn't seem cheap, because other companies which trade at 50 times earnings have much higher return on capital and are growing much faster. So if you look at price to sales, sasta lag raha hai. If you look at earnings, महंगा lag raha hai. If you look at return on capital and cash flow, suddenly it's altogether a different story. So then one has to understand what is it that we are expecting multiples to do. And all multiples will have one dominant factor. So P ratio, the dominant factor is growth. High growth companies will have high P ratio. I mean, that is a given, and you can take any number of examples. You can run a search on maybe the top 1,000 companies in India, not just as of today, as of any time in the last 20 years. Companies which grow at a high rate will always have high multiples. If the growth slows down, even the multiples come down. We have seen that across sectors. We have seen that across cycles. I mean, nothing new in that. If you look at price to book, the dominant part in that price to book, which actually is an invisible but an indirect ratio, is return on equity. Actually speaking, now price to book is very commonly used for evaluating banks and NBFCs or financial kind of businesses. So now if we looked at the, I mean, I mentioned of the example of Bajaj Finance trading at maybe 8 times or 9 times price to book versus lot other NBFC trading in the region of 1 to 2 times book. But then if I look at long-term trajectory of Bajaj Finance, it has consistently in the last 10 years had return on equity of 22 to 24%. 22 to 24% return on equity for Bajaj Finance consistently in the last 20 years. Maybe the lowest return on equity they had was maybe 20-21%. That was the lowest that they had in the last 10 years. And then if I look at Aditya Birla Capital has return on equity of 10%. IDFC has return on capital of 8%. Shriram Transport Finance has, as of now, I mean, Shriram Transport Finance, of course, a very cyclical business. But even at the highest, it has had a return on equity of 15%. Lowest it has had is say 6-7%. Mahindra Finance, similar story, a cyclical business, but on the higher side, best time it had a return on equity of 15%. On the lowest side, it has also been in losses. So there was no return on equity in those years. And hence they are all trading at 1 to 1.5 times or 2 times price to book. And Bajaj Finance consistently has been doing 22%, 23%, 24% return on equity. So then that premium valuation seems to be well deserved. If I may draw again an example of HDFC Bank and Kotak Bank on one side, because they have consistently been traded at a significant premium to most other banks. Can I request somebody to just mute? I mean, somebody shuffling papers. Yeah, so HDFC Bank or Kotak Bank, they have consistently had return on equity of 18%. I mean, you look at last 20 years data. And you've had banks which have consistently been doing return on equity of 8%, 10%, 12%. I mean, and every other bank is in that other basket. And all other reasons which banks tend to give about economic cycles and difficulty of growth, and to me looks mumbo jumbo, because my simple question to those managements is that are HDFC Bank and Kotak Bank from a different planet? Are they doing business in some other geography, or are they doing business on some other planet? The problems that you and I face are being faced by HDFC Bank also as a management team in terms of economic cycles and economic hardships, or whatever headwinds and tailwinds and everybody, the mumbo jumbo jargon that companies talk about in their quarterly presentations and conference calls and so on and so forth. So one thing is, I just strip off all that jargon, and finally, as I say, return on equity kitna hai? Where are the cash flows? How sustainable are the cash flows? And so on and so forth. As to what is the dominant factor which is going to drive the valuations, because that is what is going to drive my stock price. It also determines the future profitability in terms of reinvestment rate. That, for example, I mean, I gave the example of ITC. Just to give an example, I mean, if not ITC, it could be any company. Every company reinvests its profits. Now, if the return on capital, or even the incremental return on capital is 10% versus another company whose return on capital is 30%, it has a bearing on the future profits also. It has bearing on the growth rates of future growth rates also. I hope I'm able to articulate that for example, two companies make a profit of 100. One company reinvest, and both companies pay out 50% as dividends and 50% is reinvested. So your incremental capital in both cases is 50. One company has return on capital of 10%, another company has return on capital of 30%. So the first company on incremental basis on that 50 reinvested 10% capital employed 5 of additional profit on the additional capital. The other company with 30% return on capital, the same 50 of reinvested profit will give 15 of additional profit. We started the base as 100. So one company will have next year's profit as 115, the other company will have 105. I hope, and now this is 1 year. If this goes on for 5 years, that return on equity or return on capital consistently stays low, any amount of reinvestment for growth to catch up will be terribly difficult.
Hello, sir.
It is like saying that I'm on an expressway, I'm driving the second gear में बैठ के मैं second gear में गाड़ी में कितना भी accelerate करूँ, the car will not go at the speed of 100, impossible. Versus another company which is with a much higher return on capital, return on equity, is in the 5th gear. You can cruise at speed of 100. Yeah.
सर आपको मोमोज के साथ चटनी अच्छी लगती है कि सर वो मेयोनीज के साथ चटनी अच्छी लगती है?
Excuse me, what's this happening? No, who is this Abhishek Thapa? Who is this Abhi Thapa disturbing the presentation? Excuse me, Stuti Singh and Abhi Thapa.
Sir, please give me the host, sir. I will remove them.
Sir, remove कर दो इसको.
I don't know what is happening. Somebody seems to have.
Sir, remove कर दो. Sir, remove कर दो, ये सबको remove कर दो.
नहीं, Stuti Singh wants to take control of the presentation and take control of the meeting. What is this? Is to please take please.
A request to remove the person.
Manoj bhai, can you make me co-host? I'll do that. Yeah, just make me co-host.
Manish.
Sir, remove कर दो.
Yes, sir.
I will just
remove.
take. Yeah,
Sir, give me the host, sir. I will remove them all.
Remove.
I'll just
Sir,
take a break for a minute.
Yeah, sure.
Yeah, sure. So, Manoj bhai, can you make me co-host?
Manish is a co-host, no?
Yeah, but Manoj bhai, can you remove all these
Manoj.
people, or if you want, I can also remove it, but you'll have to make me co-host. Yeah?
Sharifi, they will leave.
I have removed, no problem.
Charas
I'll make a co-host, no problem.
Yeah, please do that. I'll keep that. I'll do that.
Yeah, sure.
चरस से गांजा मेरे को है प्यारा.
Somebody is speaking, I think, can be muted.
Something is wrong. Somebody's
Đường ra trận mùa này đẹp lắm, đường sơn đông nhớ.
Yeah, just remove the person.
Sir, somebody is trying to do.
Identified.
सर आपको मोमोज के साथ की नॉर्मल चटनी रेड वाली.
Just remove the people who are trying to do it, and we carry on.
No, sir. सर आपको मोमोज के साथ मेयोनीज अच्छी लगती है? रेड चटनी.
Who is
making noise? Can be removed?
I am removing.
Manish bhai, if you can make me the co-host, I'll do this.
Can I make a suggestion here? Someone hacked the meeting.
Somebody is hacking actually.
People without names, it will somehow take the property.
Somebody is. Somebody is hacking actually.
Just remove the person.
सर 5-6 जने हैं जो लॉगिन हो गए ऐसे.
बहुत सारे बंदे हैं और ये मीटिंग हैक हो रही है, तो सर मैं एक रिक्वेस्ट करता हूँ आप सब एक बार लीव करके अगली
Actually, somebody is hacking us, huh?
No, just remove them. That's okay. Just remove them.
Yes.
I like it. Yes, sir.
Just remove them.
Just hold on.
And Joe, can I have your Indian balls? And VB. सर आई एम फ्रॉम जूम केयर हेल्पलाइन. आपकी मीटिंग में बहुत ज्यादा लोग हैं, तो आप एक बार लीव करके अगेन ज्वाइन कीजिए. अभी हम
That's okay. Just remove them. Nobody else should speak. And who is Jagjit Singh?
Yeah, I am Jagjit Singh.
No, but who is this? How it became the co-host?
Okay, I am Jagjit Singh from I am Ahmedabad.
नहीं सर, मैंने इनको co-host नहीं बनाया है.
हाँ तो just remove him, no? Host.
I didn't become host. It automatically assigned to me.
Yeah, possibly.
नहीं. कोई
It
no
automatically
problem.
assigned to me. Automatically assigned to me.
Just remove the people who are doing the drawings.
Quit muting me, nigga. What the fuck? Quit muting me, my nigga. Like what? Quit muting me, bro.
1 minute.
Manoj bhai, this Chintan here. आप मुझे बना दीजिए co-host. मैं कर देता हूँ.
Come over there and I kick you.
चिंतन सर आपको मैंने एक मिनट. चिंतन सर आपको मैं co-host बना रहा हूँ. I know you.
Don't make me come over there and kick the Indian
Yeah,
voice
now
out of
you're
you.
co-host, Chintan sir.
Okay, got it. Thanks. Yeah, I'll keep.
I understand somebody is doing mischief.
Any people who are not identified can be removed. Any people who are not identified can be removed.
सर ये कम से कम 5 से 7 जन है जो लॉग इन कर रहे हैं.
Just remove them. Just remove the unidentified people.
Suck a dick, suck a dick.
Excuse me, sir.
पागल सी शक्ल के चुप हो जा पागल बुड्ढे.
How can someone do this actually? ये drawing ऐसा कोई मैनेज क्यों करता है?
What's to be done? Remove the people who are not identified.
Suck a dick, motherfucker. Suck a dick.
मैं तेरे को रिमूव कर दूंगा.
Why'd you kick me, bro? I'm just trying to get into some of that Indian dick. Like, you feel me, man? I'll keep coming back.
Hello?
Excuse me, sir.
Yes?
Sir, someone have leaked the link.
Yes.
किसी ने ना
Okay.
सर किसी ने
That's
लिंक
okay.
सबको
Please
शेयर
don't
कर
speak.
दी है.
Please don't speak. Just remove the people who are not identified.
Yeah, no problem. Let me see. Okay.
No identified है मोटे.
सर ग्लोबली लोग ज्वाइंट हो रहे हैं, मतलब कहाँ से भी ज्वाइंट हो रहे हैं वो लोग.
So that is okay. That is okay. Just remove the people.
Joining is not the
Quit
issue.
kicking me, bro.
People who are
I
not
want some of that
identified.
Indian balls, man. Like,
Leave it,
The
leave
people
it.
who are not
and I'll
identified.
come down there and kick the Indian voice out of y'all.
How
You
can
hear me? I'll
someone
come
do
down there
this?
and kick you in the
Joining
fucking
is
gut.
not the
You
problem,
kick
but
me
they are
one more time.
making mess
I'm gonna
here.
come
So
back and kick
Yeah,
you
I
in the
know.
People who are not
fucking gut.
identified.
Yes, Vivek, you can go ahead. Let us see what somebody is doing.
I had muted myself.
Yeah, Vivek, do the screen sharing again. Remove the screen and reload
Yes,
it.
sir.
Yeah.
Reload the screen.
स्टॉप शेयर एंड रीशेयर अगेन तो आपका
Yeah.
निकल जाएगा ये सब.
That's what I'm wondering. How does one stop share? Okay.
Yeah. Yeah, reshare.
Yeah. So we were at this slide.
Yes, okay.
Yeah. So I was giving an example. So I'll just take that example again. In terms of two companies, both assuming both have base level of profits of 100. A very simplistic example I'm giving. It's only for academic purpose to understand this price to book and return on equity and so on and so forth. Say two companies both have
Sir, somebody has taken control. Manoj bhai, somebody has taken control actually.
I think it's back. It's back now. Yeah. I removed. There was some Chinese guy who was there. I removed that guy. Okay.
Okay, then it's fine, Chintan bhai.
Yeah, okay. So two companies with base level of profits of 100, they have a dividend payout of 50. A simplistic example we are taking, say one has return on capital of 30, the another has return on capital of 10. So the 50 that is reinvested, 50 that is payout as dividend, pay 50 is reinvested. So this first company has incremental profit on that of 15, because 30% return on capital and 50% is a reinvestment rate. On base level of profit, it makes 115 of profit next year. That's 15% growth rate. The other company, 10% return on capital, same 50 reinvestment, makes incremental capital additional profit of 5. So say second year, one company has profit of 115, the other has 105. Now, if this goes on, the company which has higher return on capital will consistently keep growing faster because certain reinvestment rate gives them higher output in terms of profit. I mean, think of reinvestment rate as the input of capital and earnings as or profits as your output. So efficiency is much better. Now, for the second company to match that 15% growth, अभी उसका तो return on capital, उसका capital output तो खाली 10% है. So for him to generate additional 15 of profit, his reinvestment has to be 150. 150 में तो profit तो खाली 100 है. So he decides, okay, they don't want to pay dividend, the entire 100 will be reinvested, plus 50 of additional capital will be taken from outside. So either that additional 50 will come out of borrowings, or they will dilute equity and raise equity by rights issue or QIP or whatever, and generate that 15 of additional profit. But what happens as a result? The second company has a disproportionately larger balance sheet compared to its earnings. The first company has got a much leaner balance sheet relative to its profits, and which is what we see in a lot of the FMCG companies where, say, a Hindustan Lever or a Nestle, who have return on capital which is in excess of 50%. At times it has been like return on capital of 100%, where the total capital employed on the balance sheet, the profits are as much as the capital employed, and there have been several years that these companies have had that. And then is it a surprise that some of these companies trade at a significant premium to other companies in the market? Well, it really is not a surprise. It was not a surprise. I mean, I used to find it surprising 20 years ago. I used to find it surprising 15 years ago. But then when I notice these differences, when you compare companies in terms of performances, fundamental performances, you notice that some of the companies are inherently far more efficient in terms of generating a certain amount of profit relative to the capital employed that they have. The Indian IT companies also are in the same basket. Not only are they debt free, they obviously have no borrowings. Infosys, TCS, HCL Tech, Wipro, Tech Mahindra, you name one, maybe the top 10 companies don't have any borrowings at all. Yet they have a lot of surplus cash on the balance sheet, and if you remove the surplus cash and see how much of capital is actually in the core business, it will be a very small number. Compared to that, the profits that are generated is a disproportionately large number. And that is what explains the differences of companies having high multiples or low multiples. So if we look at companies, why do all paper companies or why always have very low multiples? But for the last 20 years, if I look at all the paper companies, even the best paper company has not had a return on capital more than 10 or 12%. I'm talking the best paper company. The worst ka to baat hi nahi karna hai, but even if you look at averages, because life is not about the topper of the class, life is about the average performance of the class. Even when we went to college, although the topper of the class was who made news, but all of us, I assume most of us were the average bunch in the middle. The average profits of the paper sector as a whole in the last 20 years, the return on capital has not exceeded 10%. So then why is it a surprise that paper companies, irrespective of the cycles, get very low multiples? I mean, it's no surprise to me actually. And we could look at sector after sector after sector as to why this has happened or why this has changed also. In some cases, like in chemicals, it has changed in the last 5 years. Earlier, it used to be a low capital, it used to be capital intensive, a very low capital return on capital business. What you notice in the last 5 years is all of them have return on capital in excess of 15-20%, and consistently they seem to be maintaining that. Yeah. So this is about multiples. I mean, you would recollect earlier slide, the 3 categories of multiples. So this is as far as the multiples are concerned, the multiple-based valuation. So we come to the second category, asset-based valuations, which is one of them is replacement cost, which a lot of people tend to keep. I mean, this replacement cost theory is also like cyclical. I mean, it keeps coming back and then people forget about it also. People don't talk about it. Suddenly everybody starts talking about it. So basically replacement cost is methodology to value existing firms based on what it would take to set up a new company with similar assets and their business profile? So if I look at a Shree Cement with a capacity of 25 million tons, if we need to create another Shree Cement 25 million tons of cement capacity, how much will it cost? Versus what is the market cap or what is the enterprise value of Shree Cement today? Because if you had to buy Shree Cement, pura company take over kar liya, what would it cost versus what would it cost to take over the entire Shree Cement with all its liability versus what would it take to create another Shree Cement of 25 million tons cement capacity? That is what is the replacement cost of the assets of Shree Cement. So this kind of thing makes sense in a scenario where creation of new capacity is difficult or creation of new capacity will take time. It's not key we can set up 25 million capacity in next month. 25 million capacity खड़े करने को 20-10 साल लग जाएगी. And in those 10 years, Shree Cement would have generated few thousand crores of profits actually. A lot of the M&A activity tends to focus on this methodology because that is what an acquirer is looking for. That either an acquirer can expand his own capacity or take over a smaller player or take over another player because he has ready-made capacity which will probably take few years to set up. Versus that he can take it over today itself and start getting profits from tomorrow. So which is what they will look at, that how as a matter of payback as to what would they pay versus how much of profits will they get against that existing capacity. It could also be for acquiring new customers. You may want to acquire new customers, you may want to get into a new geography, and rather than spend time acquiring customers, you may just acquire one of the existing players and acquire market share. All of this is a function of replacement cost. What would it do? What would it take to replicate an existing business? Another of asset based valuation is liquidation value. Now, liquidation value is usually spoken, discussed, and in the media, especially thanks to NCLT in the last few years. I mean, companies which have gone sick or gone bankrupt and are in NCLT. What is the NCLT administrator or the liquidator looking at? He's basically looking at the terminal value of asset. Business तो खत्म हो गया, business है ही नहीं, मतलब P&L account है ही नहीं, अभी balance sheet में जो बचा है उसका क्या value है? I mean, that is what I will talk in layman's language. I mean, that's key. As I said, I'll strip off the jargon and all of that mumbo jumbo. What is the crux of the issue? What is the asset? What are the assets? What is the value of the asset? Whether the assets can be value unlocking हो सकता है कि नहीं? और वो value unlocking में can there be any proceeds in terms of cash payouts and so on and so forth? So if we look at most of us who are in Mumbai or even outside Mumbai, applies everywhere actually. Say old factories and textile mills, most of them were loss making when they were in operation. Suddenly, when you look at the alternate use of the land, I mean, the company or that asset becomes very valuable. If it was a textile, if Phoenix Mills was a textile company at Lower Parel, if it continued to be a textile company at Lower Parel, what would be the market? What would have been the market cap of Phoenix Mills versus if they've converted to a one big mall? And what is the value of that single property now? Which is what change of ownership or change of alternate use of assets. The same assets as mostly when we say alternate use of assets, it's largely about land itself. Because what else can you do with the other assets? Other assets largely go in scrap value. So this is about replacement cost and liquidation value. It helps to understand the value of existing companies, especially in a downturn. When I say especially in a downturn, so let me give you an example that last 2 years we have had intermittent lockdowns and so on and so forth. So obviously the hotels business was, for substantial period of the last 2 years, hotels were not in business in the first place. I mean, all hotels were shut. I mean, nobody was going and staying in hotels. So obviously the Indian hotels company, I mean the Taj Group and the Oberoi Group, which is EIH and so on and so forth, all of them reported losses for obvious reasons. I mean, business in nature, I mean, there was no top line itself. I mean, our top line was substantially lower. Fixed costs were already there, they are built in. But does it mean that because those hotel companies have been running in losses, they don't have value? No, that's not really the case. The land and the building and the hotel properties that they have a certain inherent value, which is the asset value. If you had to create the Taj hotel chains or an Oberoi hotel chain again, all over again, it's firstly going to take a very long time, and it's going to take a humongous amount of additional capital to recreate all of those properties. Versus that, an Indian hotels or an EIH already have a certain inherent value. So what if they're not making profits today? They do have a certain replacement value or a liquidation value. Liquidation value would be a wrong word to use, but they do have a certain value. And that is what the value is about, asset base. Okay, so now we come to the third category of valuations is discounted cash flows or dividend discount model. It basically is to remove the relativity and subjectivity that we have in the multiples. So basically both are present value of future cash flows. So in case of DCF, we are talking of present value of future cash flows for the company. In case of dividend discount model, we are talking of present value of future cash flows for the investor. Because as an investor, if I'm a long-term investor in a company and I don't sell my shares, what is it that I'm going to get? I'm only going to get dividends. So then what is the value of the dividends that I will get in future? That is what is a dividend discount model. So basic assumption of this discounting is that every asset has an intrinsic value that can be estimated. It's possible to estimate. It's not impossible. It may be difficult, but it is still possible. Based on its characteristics of cash flows, growth, and risk. That the asset will give you profits, it will give you cash flows, it will give you a certain growth. All of it will carry a certain business and economic risk, but they will still generate, hopefully they will generate profits and cash flows in future. That is what the asset is supposed to be. That is what any asset is supposed to do. So to work on DCF model or a DCF valuation, you need to estimate the life of the asset. Mostly in case of corporates, it's a perpetual life. I mean, obviously corporates don't die. They may go out of business, but corporates per se are assumed to have perpetual life. Estimate the cash flows during the life of the asset. Estimate the discount rate to apply to these cash flows to get the present value. Now the discount rate could be the cost of discount rate generally is the cost of capital. It could also be your prevailing interest rate scenario. So if the interest rates are rising, you appropriately increase the discount rate as well, because your cost of capital is likely to go up in future because of higher interest rates. The other is conceptually, it's correct that you apply, you apply the relevant discount rate, which is in line with the prevailing interest rate scenario. So what are the features of the DCF models? Firstly, they are objective. It takes away the subjectivity whether 5 times earnings, 5 PE is cheap and 50 times the expense is the whole argument. This DCF thing will remove that argument only. It enables standalone evaluation as well as comparison of apples with oranges, since even the subjective factors are attempted to be captured in numeric terms. So we mentioned that things like brand equity and management quality may be subjective, but then you can convert that subjective factor into an assumed growth rate. That if the quality of management is superior, growth rate will be higher, return on capital will be higher, so on and so forth. A company with very strong brands, whether it's a Marico or a Nestle or a Hindustan Lever or a Gillette, how strong is the brand is a subjective thing, but the strong brand, the strength of the brand and the distribution network has to result in a certain growth rate. I mean, if it doesn't give you the growth rate, then my next question is, brand value ka kya matlab hai? Growth hi nahi hai. Yes, so you can convert that subjective factor into an objective factor by assuming a certain growth rate. Now, whether that assumption, whether it's a high growth rate, low growth rate, high or low growth rate, is a matter of argument. But with experience, with economic trends, with trends in what the sectoral growth rates are, it is not very difficult to assume a certain growth rate for every business. cash flows in the near future always will have greater value than cash flows too far into the future. It is obvious, right? I mean, it's an arithmetic. When you take a discount rate of, say, for example, if I take a discount rate of 10%, next year's cash flow by the discount rate will be 0.9. The year after that will be 0.81. And that number will keep falling by 10% every year. So obviously today's profit has a factor of 1, next year's profits have a factor of 0.9, and profit after 15 years will have a factor of 0.06. So obviously the near-term cash flows are more valuable than the very long-term cash flows. In a dynamic or a murky environment, looking too far into the future may be fraught with risks. Then it's no different than crystal ball grazing actually. Then it's only imagining. It's like if somebody were to say, oh, Paytm will make 5,000 crores of profits 20 years later. 20 साल किसने देखा है? 20 साल बाद Paytm रहेगा कि नहीं वो भी मेरे को पता नहीं. So is there any value in putting that statement that Paytm will make 5,000 crores of profits 20 years later? I mean, to me, it's a meaningless statement actually. Or it's at least I will not buy into such an argument. And why only a Paytm? If somebody were to tell me that, oh, Gillette will make 10,000 crores of profits 50 years later, yeah, it's possible. I mean, Gillette will probably survive 50 years because 50 years later people will still need to shave. दाढ़ी तो बनाना पड़ेगा लोगों को. But I don't know what is going to be the value of profits at that point of time. Which is what we are saying, that too long into the future is always risky to estimate. So it's better not to do that. And as a result, accuracy of all these models will depend upon what kind of assumptions you are taking on growth rate, which is also your cash flows, and your discount rate. Because there'll be a world of difference of a discount rate of 8% and discount rate of 12%. If one were to actually work a spreadsheet, change of that 8% going to 12% may seem 4%, but in your DCF value, the end result could be a difference of 70%, actually speaking. Whether you assume growth rates to be 10% in the next 5 years, I mean 10% compounding growth for the next 5 years versus assuming 15% for the next 5 years will also make a very large difference in your end DCF number. So, which is what we are referring to, that it is what kind of assumptions and estimates you make. You can't hide away the fact that you have to make assumptions. I mean, otherwise future projection hota hi nahi hai. So something which I touched upon earlier, that if globally in a rising interest rate scenario, why do equity markets have to fall? Finally, what interest rates will go up, what 0.5% in the next 6 months or 0.5% in the next 1 year? And somebody was arguing with me, what is 0.5%? 0.5% to plus minus every hour stock prices move 0.5% plus minus every hour. And here we are talking 0.5% change of interest rate in the next 1 year. Is it a joke? Well, it's not actually a joke. When you adjust that 0.5% discount rate in your DCF calculation, it makes a substantial difference in the end value, and that end value could be 20% lower in terms of your discounted cash flow number. I'm not getting into the technicalities in terms of working out a spreadsheet with a DCF, and it would be too time consuming. We will be sitting here till evening doing that. But it is about getting the familiarity as to how do different factors as input variables affect the output variables, which at the end of the day is your market price of a security. That is what we are interested in at the end of the day. At the end of the day, we are interested in making profits. We are not interested in the academic calculations per se. So we may not do the calculation, but what is important is what do those calculations mean is what we need to understand. Okay, so some more which are again variations of the previous ones also. Take the dividend yield. It is the simplest to understand. It is the most objective and easiest to apply. So if I were to say price of coal India is 160 rupees as of today, Last year it paid a dividend of 16 rupees. It is likely to pay a dividend of 16 rupees this year also and next year also. Matlab next 2 saal 16 rupees a minimum dividend is assured. So you have your 10% dividend yield. 10% dividend yield in coal India, very easy to understand. Even a layman or a duffer भी समझ सकता है कि यार 10% ब्याज छूटता है, 10% ब्याज है coal India में. And it is easiest to apply when because you can compare it to others also. कैसे NTPC में कितना है, Steel Authority में कितना है. I mean, if you want to just compare PSUs, for example, you could have industry-specific models which are enterprise value per ton of cement capacity. It is nothing but an extension of asset-based compared with DCF. So if you say, oh, enterprise value of Ultratech is $300 a ton, I'm just giving an example. It's not an exact number. I'm just a random number. Versus what will it take to set up another similar capacity is basically the same thing. Value per customer, example, ARPUs in case of telecom or in case of cable companies and all that, which is ARPU is average revenue per user. It could be monthly, it could be annually, whatever you take. It is nothing but ARPU is nothing but your sales number. So obviously it is something related to sales number. Market cap to sales, I mean, ARPU will be something similar to that. Valuations could have strategic considerations. Entry into a key market, like Walmart wants to enter India, which is the largest consumer markets by virtue of the population. But obviously, FDI in retail is not allowed. The best option that they had was acquire Flipkart and start doing business in India. So when one could argue over Flipkart was valued at $10 billion by Walmart, and what is the rationale of value? How is Flipkart so much more valuable? Well, Walmart paid a certain premium to enter India, because otherwise they could not have entered India to start with. Control of strategic assets. So we know when many years ago Sterlite acquired Kane Energy. Kane had oil fields in Rajasthan. Obviously, Sterlite wanted to have control over those strategic assets. 20 years ago, they acquired Hindustan Zinc in the privatization process when the government privatized Hindustan Zinc. Hindustan Zinc has one of the most valuable mines, or one of the largest mining capacity in zinc is with Hindustan Zinc. Obviously, Sterlite, I mean, anybody who has control over that mining capacity would be a dominant player in the zinc business. These are things that happened in the past. What is happening currently? BPCL, Bharat Petroleum privatization has been announced by the government last year. It is in the process. Obviously, it's going to have, I mean, whoever acquires it will have strategic considerations in terms of entry into a very large oil and gas market, refining and retailing of petroleum products, with some mining assets overseas also. So the next slide as to in terms of what really works and what really doesn't, and how does one apply all that. So the problems all are about predictability of future or lack of predictability, because investment is always made for future, and you need to think as to what the future can be in terms of growth and cash flows and so on and so forth. Highs in profits. Profitability can be very high, lows can be very low. So if we look at steel prices globally in the last 1 to 1.5 years have gone up, and which has witnessed steel companies delivering profits that they have probably never seen for a very, very long time. Probably never in their lifetime would SAIL have seen the kind of profits that it is reporting now. But when the steel cycle was down, Steel Authority used to report losses also, and we have seen losses in Steel Authority many years ago, or some years ago, when the down cycle in this sector was there. So, but what happens is expectations about future are always driven by near-term experience. Abhi steel prices are up, and then there are every justification steel prices will remain up, and there will be arguments, oh, China is shutting down capacity because of pollution and so on and so forth, where the assumption is that steel prices will continue to remain high and the profit margins of Tata Steel and Steel Authority will always remain high. I mean, all of this is on a strong belief. No, this time is different. Cycle cannot go down at all. I'm sure all of us hear these kind of arguments from enthusiastic market players who are very bullish on cyclical companies. But then obviously life is not that way. Life is never one big upcycle. There always does follow a down cycle. So what does one do? That even if you have to use multiples, you need to accommodate for long-term trends within those ups and downs. So if you look at profits of, say, a Jindal Steel or Tata Steel, if you look at only the domestic operations, for example, for simplicity, profits may have been higher or lower. Profit margins would have been higher or lower, but over a 10-year or a 20-year period, the trajectory of profits has still been on the uptrend only. It has always been an uptrend. So even the down cycle level of profitability is still higher than the previous down cycle profits that Tata Steel made. Large part of it is contributed because of volume growth. Yet even on a per ton basis, if the steel, even if they made lower profits, but just simply the higher volumes today versus 10 years ago itself gave you a certain upward trajectory in terms of profit. So you can accommodate for long-term trends within those up and down. In a DCF-based approach, obviously you need to make multiple scenarios of optimism and pessimism as to what the commodity prices can be, or I mean, one really doesn't know what the prices will be next week, let alone knowing what the prices will be, so what the steel prices will be 2 years later. I mean, impossible. I mean, anybody who says he can predict that is either Bhagwan hoga ya jhutha hoga. I mean, he's a liar, or he's probably God who knows all that. We are lesser mortals, obviously, and we are honest people that we don't know what. So you build in multiple scenarios, assuming high levels of steel prices, lower levels, maybe a 20% lower prices, maybe 50% lower prices in terms of the underlying commodity. You can take an average of various models that come out, because you're still going to get a certain number for all of them in terms of profits or losses. You can take asset-based works very well during downturns when profits are low. I just gave an example of hotels or malls or multiplexes who were shut during lockdown. So they had no business. I mean, they had no revenues, or they had very little revenues, and they reported losses in the last 6 or 7 quarters, hotels, malls, multiplexes, all of those businesses. But they inherently have a certain value that if business was normal, they will have a certain normalized rate of profits that will come back. So continuing with that, valuing asset-rich companies. How does one value asset-rich companies? So some businesses are inherently asset-rich, like hotels, malls. I mean, they have large land and buildings and all of that, which has a certain real estate value. Certain companies are asset-rich for historical reasons. So say Bombay Dyeing has large amount of land in Worli in Mumbai. They also have it in Dadar, where they are building a very large project. Island City Center is what their construction has started. It's a multi-year project which will probably go on for another 5 years. A lot of PSUs have a lot of land holdings for historical reasons. Of course, it's unlisted, but we know that anybody who's familiar with Mumbai, Vikhroli, much of Vikhroli is owned by Godrej. In terms of Godrej has huge amount of land in Vikhroli, which is a suburb in Mumbai. Those who are not familiar with Mumbai. For historical reasons, Baap Dada ne zameen kharid ke rakhi hai, padi hai zameen. Now the land is very valuable for obvious reasons. So how do you value such companies who have an operating business also and who have very large land holdings or proper asset holdings? And those assets don't necessarily generate profits or cash flow. I mean, it's just surplus land or surplus real estate. Often the market price a significant discount to the value of underlying assets. And why is that? And as a result, M&As don't happen. I mean, if you were to go and talk to Mr. Godrej, I want to buy out all the Godrej companies, what will Mr. Godrej say? Will he accept your valuation based on profits of Godrej company, or will he talk about the land value? Obviously, Mr. Godrej is going to start talking about the land value, because land value is substantially more than the profits of the company. and udhar hi baat khatam ho gayi, because obviously the land value is so large that nobody will buy that land. I mean, nobody will buy the Godrej companies for the land, and neither is Mr. Godrej going to sell, which is why the M&A will never happen. Buyer bhi interested nahi hoga, seller bhi interested nahi hoga, but you still have to value it. I mean, if you do have to value them, so you can take asset prices at market rates, assuming that asset is being put to alternate use. So in case of Bombay Dyeing, for 50 years that land was there, land was not earning, land and property values were much higher than the profits the company was making. Obviously, that asset wasn't contributing, but now that it is becoming a real estate company, that surplus land is being translated into real estate and sold on a square feet basis, you can start valuing the asset as market rates, because now you have predictable cash flow, because the project has been launched, they have started doing the booking, they have started building the construction, and you know that in next 5 years that project will be delivered and that land is going to convert to building and cash flows. So there you can start using earnings multiples or this dividend, DCF, because now there is predictable cash flow which is likely to come. Maybe if not in 5 years, it'll take 7 years, but you still. Century Textiles is another case where they have been doing huge amount of real estate development at Worli. Once upon a time, what used to be Century Mills, Century Textile Mills. So all of this valuation depends upon what the assets are being put to use. If the assets are being put to use as real estate, like Phoenix Mills has done, but Phoenix Mills is not selling the real estate, it is deriving rental income, then the value of Phoenix Mills is not the actual capital value of the real estate it owns, but how much rental it is getting, because then you need to discount the rental, not the actual property value, which will run into few thousand crores. In case of hotels also, it's net revenues and not necessarily the market value of the land and the building that hotels have. We mentioned of potential value unlocking, Bombay Dyeing, Century Mill, Century Textiles, and so on and so forth. But what is also important is what is after value unlocking, what will the company do with all that cash which is generated? Will that cash come to the investors, or will it be put into some other asset which will probably generate much inferior return on capital or return on equity in future? Well, we don't know what Century Textiles or Bombay Dyeing is going to do after all their real estate development has happened, and what will they do with the cash flows. But whenever the respective managements come out clearly on that, we can take a call on whether that's a good strategy or not. Now, this is something which all of us are intrigued and all of us are obviously excited in, that how are IPOs valued and priced, or how are disinvestment priced. So, I mean, obviously there is somebody sitting in the government of India, the Department of Disinvestment or Finance Ministry, whichever whoever the people, how do they value disinvestment? That now all of us know there have been some 30 companies put up for sale, which will be privatized in the next couple of years, but how will they price it? How are IPOs priced and how are IPOs valued? So first, the motherly statement is pricing is not the same as valuation. In fact, pricing is exactly opposite of valuation. They contradict each other. So what we need to understand is who is doing this pricing and who is doing the valuation, and what is their objective. दोनों का objective क्या है? दोनों का स्वार्थ क्या है? जो pricing कर रहा है उसका स्वार्थ क्या है? जो valuation कर रहा है उसका स्वार्थ क्या है? So investment banker or the issuer, so here the issuer is the company who's coming out with the IPO, they obviously want the maximum possible price. Bull market है तो जितना price मिल सकता है ले लो. You and I, all of us are buyers or investors of that IPO. We obviously want to pay the lowest possible price. We are the population who will participate in all the mega sale. जब sale होता है तब हम खरीदी करते हैं, तो फिर market में why is it different? We obviously want to buy things at the lowest possible price. So it is a buyer who's doing the valuation. The seller is doing the pricing, because the seller is deciding the IPO price. Paytm price of 2,100 rupees IPO price, Zomato 75 rupees IPO price, or so on and so forth. The seller of the IPO is doing the pricing and telling you that this thing, ye cheez hai, ये इसका प्राइस टैग है. It's no different than you go to a mall and mall में वो हर चीज के ऊपर प्राइस टैग लगा रहता है. IPO is also one big mall. Imagine it to be one big mall, a marketplace where the company coming out of the IPO has put a price tag. It is for you to accept the price tag or not. Subsequently, reality strikes. So most IPOs which came in the 2021 bull market IPOs were priced much higher than the inherent value. Most of them are now quoting at less than issue price, or a lot of them are below the listing price. Because at the time of IPO, pricing and valuation is being done by people who have opposite objectives. But subsequently, when it is in the market, pricing and valuation do have to start having a correlation. And what we are seeing is all the IPOs being quoted at a discount now, or quoting the below listing price, is where the convergence of price and value is now coming. So what happens is the merchant bankers suggest a price in relation to likely demand and supply and mood of the market. Market sentiment is very bullish. So obviously, merchant banker company ko bolega, promoter ko bolega, we can get even a higher price. Valuation argument by the merchant bankers or by the promoters of the company is only an argument to justify that higher price. Most times it's humbug. I'm using the word, I'm making a bold statement, a controversial statement. Most of the time it's a humbug argument. All of us who can revisit the interview of the Paytm management, who at the time of the IPO said, oh, we are leaving substantial value on the table for the investors to make money. Even at 2,100, Paytm management thinks that there is value for the investor even after 2,100, after buying at 2,100. That is his valuation argument, which according to me, or which according to large number of market participants is humbug, because now the price is less than 900. So 2 महीने में ऐसा क्या हो गया कि at 2,100 there was a lot of value and now there is no value. On the other hand, for us as investors who are doing the valuation, evaluating that IPO, the same principles will apply as any other listed company. That you are evaluating Paytm, why would you evaluate a Paytm differently than evaluating a TCS or an Infosys or a Nykaa or any other company that is already listed? There are actively traded 3,000 companies, there are 7,000 listed companies, and there are at least 500 companies of some reasonable quality out of the 3,000 actively traded companies. So why should that be very different in case of evaluation? So same methodologies and same arguments, same process has to be used for valuation of IPOs also. So this is as far as my presentation on valuations. Thank you for patient listening. It's been more than 2 hours actually. Thanks everybody for the patient listening. Happy investing. I did go a little overboard, which apologies to everybody. I was talking to Manoj Bhai yesterday. Manoj Bhai asked me कि कितना time लगेगा. मतलब हम तो politician है, सामने जनता है और हाथ में mic है, तो हम तो बोलना चालू कर देते तो control नहीं रहता है. So ending that with a little joke, not that there was any politics in this presentation. I refrained from any politics in the presentation, but hopefully it was helpful. Open to any questions, queries, clarifications, comments. And with this, Vivek
bhai, this Chintan here. Just one question. Can you speak a little bit on how do you value a holding company? Yeah?
Okay. So, Chintan bhai, can I take the liberty of addressing that separately? Sure. Actually, this very presentation, I deleted the slide on valuing holding and investment companies. And there I had two slides on valuing holding and investment companies which have no underlying business but are pure holding companies. They don't have a business of their own except to be holding company. And you have another set of holding companies who have an underlying business of their own, but they are also holding companies of holding shares of group companies. So let's take an example of Adani Enterprises. Adani Enterprise has its own business. There's an underlying business, and it is a holding company of all other Adani companies. So it is also the holding company of Adani Total Gas, it's Adani Transmission, Adani Power, Adani whatever अभी Adani Wilmar का issue आ रहा है, तो Adani Enterprise is a holding company of all of them. So there is a holding company value and there is a business value of its own business. Versus the pure holding company, which there are a lot of them, which, but that is a little longer discussion than this. Can we do it some other day, some other time? Then we
Sure.
can do it in more detail with a better discussion with numbers in front of us.
Sure, Vivek bhai, no problem.
I'm sorry for that, but we can keep it in as a to-do list for future interactions. I mean, think tank team can keep that as a to-do list for maybe in the next few weeks. It can be addressed.
Sure.
Apologies for this. Yeah, I was just going through the chat screen. If anybody has put up any questions or queries on in the chat screen, and I'm at least I don't see any.
Vivek bhai, Manish Tangu here.
Yeah.
I have a query, not query, rather I have 1, 2, 3 things which I really have a problem whenever I do, analysis.
Yeah.
One thing is corporate governance.
Yeah.
We know the corporate governance, what is happening in the companies from time to time. Like latest is this ICICI Bank, Rama Bijapurkar.
Yeah.
Right? It's a corporate governance issue only, right? Correct?
Yes.
Third thing, I used to watch Sun Pharma since 7, 8, 9 years.
Vivek, can you put the cover slide on the screen? The cover slide, title slide.
Just a moment. Then I'll do the screen shares. I'll do share.
Yeah. So it is on the slide mode.
No, so okay. So wait. Share.
Yeah, Manish, you can carry on what you were saying. Yeah.
Sure. I used to follow, Sun Pharma from time to time. Well, the whole, I think 3 years back, there was the same problem of related party where company was doing some kind of job work or purchases from the sister concern or a company owned by the promoters. But it was never, shown in the annual accounts. I think you remember, right? So how, like, as a, general person, I'm a chartered accountant, I can find something more. But as a general person, we cannot find what is happening inside the company. Unless you meet the management, you assess the management, or you have some conclusion when you meet management. So what is your thought on this? Hello?
Vivek?
I think sir, उनका चला गया लगता है ये.
Vivek?
Not there.
Maybe some network issue.
Yeah, network issue, definitely. Yeah,
Vivek, you were there?
Chintan bhai, what is your thought?
Yeah.
Chintan bhai.
Aryan is raising his hand. Aryan, would you like to put on your video on and speak on the Sun Pharma?
Hello.
Yeah, just put your video on, Aryan.
Video is disabled from your side, it seems.
Chintan bhai, सबका enable कर दो, Chintan bhai.
Sorry, I was away. Can you just repeat, Manish bhai?
Chintan, can Aryan put the video on?
नहीं, I think sir कुछ problem है सबका.
That's okay. Make Aryan the co-host.
Done. No problem.
Aryan is the IR person.
Yeah. Good. Aryan bhai, what is your thought on
make him the host? He has become the host.
Yeah. Sir, I have a question for Mr. Vivek.
Vivek, we are waiting for you.
Vivek ji, are you there?
He is not there. Unka network cut gaya lagta hai.
One second. Somebody has to admit Vivek back in. He's trying to get in because of the lock.
Manish, you'll have to go to waiting room and do that. Yeah, I enable the waiting room.
Waiting room में कहाँ जाऊँ sir?
Yes, sir. You are the host, so only you can do that.
Aryan, can you make a Chintan the host? Aryan?
Yeah, sorry.
Yeah, Aryan, make a Chintan the host.
Actually, see, I tell you, मैंने आर्यन को host बनाया था, but वो host बन गया है अभी.
No, just make a Chintan the host.
Yeah, Aryan can do that. I cannot do that now.
Aryan?
Yes, sir.
Can you make Chintan the host?
One second.
Yeah, Vivek is waiting. Yeah.
Manoj bhai, if you want, I can remove the waiting room so he can directly join in, and then
wait. कर दीजिए, चिंतन भाई कर दीजिए.
Okay, so I think now if he tries, he should be able to get in. Yeah.
Hello. Hello.
Unable to join.
Now if he start, now if he tries, he should be able to join. Yeah.
And Aryan, can you make Chintan the host? Vivek, you could join. Still Vivek is waiting to join. Can you check?
Manoj, he should be able to join now. If you can ask him to try once again.
No, I told him. He's saying try once again.
Okay. Now I'm
Yeah. Yeah. And Aryan, just to make a Chintan the host, no?
Yes. Sorry, friends. I just had a problem with little Geo.
Yeah, it's okay. Carry on.
Yeah.
So, Manoj bhai, I'll again lock the meeting, right, and enable the waiting room. Okay.
That's okay. I think, Manish had some point on Sun Pharma, and then Aryan wanted to speak also.
Yeah, Vivek bhai, मैं क्या बोल रहा था कि I used to see Sun Pharma from quarter to quarter and analyze the data. But 3 years back, there was some corporate governance issue was there because company was doing very big amount of job work or purchase from the sister concern, and that was not shown in the books of accounts. So when you have a Big Four as auditor, how such things can happen? Hello.
Wait, yeah. So there are two things that happen actually. Before I got disconnected, you were giving the example of ICICI Bank as well.
Sorry? The video on.
No, I cannot switch on the
Aryan,
video.
just make a Chintan the co-host, no, Aryan?
Well, I'm not able to switch on the video because the host has stopped it. But anyway,
Aryan, can you make Chintan the co-host and Vivek the co-host also? Make Chintan the host. Aryan? Make a Chintan the co-host and Vivek co-host. Make Chintan the host.
Yeah. So anyway, I'll go on with at least the answer. So whether it is Sun Pharma or whether it is ICICI Bank. So in case of Sun Pharma, I mean, I'm not very familiar, but as you say that there were large amounts of purchases or job work being done from sister companies, and so basically it is nothing but indirect transfer of profits from the listed company to the privately held entities owned and controlled by the promoter. Is it not? I mean, now, what does it mean for the listed company? Because we are interested in what happens in the listed company. Profits of the listed company are lower by that much amount. For example, if the private companies have benefited to the extent of 100 crores, मतलब listed company में 100 crores profit कम आ गया. Correct. All of that finally reflects in your growth. All of that reflects in your earnings. It will reflect in your return on capital for obvious reasons. Yes. What we are concerned with is the reported numbers and the adjustments we make with the reported numbers, because I don't know what every promoter is doing and not doing, what every promoter is doing right or what every promoter is doing wrong also. If I were to go by the reported numbers in terms of the growth, profit margins, cash flows, return on capital, return on equity, dividend payouts of Sun Pharma as a listed company, I'm more concerned with that. If the profits have been understated because there has been transfer to some other company, it shows in your listed company ना उतना earnings कम है ना, तो कम earnings पे कम multiple मिल रहा है. Now, taking the example of ICICI Bank.
Vivek.
Yes, yeah.
Vivek, Sanjeev Pandya here.
Yeah.
I could add to a little to that because I played that whole cycle and watched it very, very closely.
Oh, sure, yeah.
So no, you finish your ICICI point, because there also I mean I knew the bank.
And just a request to put your video on.
Okay.
Vivek, you can put your video on. You're the co-host now. Yeah.
Okay. Good. Now,
and
as far as
identify yourself when you speak and put the video on.
Yeah. Okay. Now, taking the ICICI Bank issue in terms of this Rama Bijapurkar issue, which happened last week or which came to light last week, it must have been probably happening for a long time. वो तो अभी पकड़े गए. It's probably much minor issue relatively. The larger issue was what was happening under the previous managing director, the great Madam Superwoman who was running the bank for many years. And so, so I'm referring to Chanda Kochar. Probably those were far more serious issues of corporate governance in terms of I was in a case of ICICI. So I had that slide about, and where I mentioned about HDFC Bank or a Kotak Bank or a Bajaj Finance. And if you look back 5 years ago or 10 years ago, what the balance sheet and the performance of ICICI Bank, NPA numbers were much higher in percentage terms also, in absolute terms also. What do we have now in the last 2-3 years with the change of leadership at the top? The NPA numbers are lower, profit margins are higher, growth rates are higher. Is it not visible? I mean, if you take last 2 years versus the previous 5 years. So there is a qualitative improvement in the performance of ICICI Bank simply looking at the numbers. I'm just talking from a layman perspective. मैं चंदा कोचर को नहीं जानता, मैं संदीप दीक्षित को भी नहीं जानता हूँ. I don't know how good or bad they are. I'm simply saying there was a change of leadership at the top which resulted in change in performance positively. And market has recognized that change of positive performance, and hence the stock price, which used to be 250, 300 3 years ago, is today at 700. I mean, we can look at the long-term 5 years P&L account change of performance positively, and वही आपका दूध का दूध पानी का पानी हो गया. And which is why your price, which used to be ICICI Bank 1.5 times price to book, today is 3 times price to book. Which is what I was that slide on. What drives multiples? Management quality. Your growth rates are higher. Your return on equity has improved. Your net NPAs have come down. Market has recognized all those positive improvements in the performance and now giving it a higher multiple than it used to give earlier. I hope that answers your question. Now, Sanjeev Pandya has got, I mean, I'll take the liberty of introducing him. He has had illustrious corporate career for the last more than 25 years. He has held CFO level positions in companies like SRF and all that. So if we have seen transformation of SRF in the last 10 years, Sanjeev Pandya was one of the brain behind it in the senior management at the level of CFO. So fairly illustrious person, for somebody far more knowledgeable and experienced than me. I have tremendous respect for Sanjeev bhai. I'm sure he has a lot more he can add on corporate governance matters, since he has been inside a corporate. Most of us are market participants. We are not inside corporate. He has been inside a corporate. Yes, over to you, Sanjeev bhai.
So just picking on your point about playing valuation arbitrage cycles. So this was one. In fact, I coincidentally played the Sun Pharma one because I realized very quickly that this is exactly what I would do as a CFO. You know, there are expenses that you don't want to be scrutinized because all kinds of, you know, and practically, if you see, the income tax guys love to you know, argue with you about certain kinds of expenses. Now, those expenses had to be pushed out into, let's say, a private limited company. A lot of people do that. The important thing that I noticed about Sun Pharma is that the intent was not bad. Out of 30,000 crores of cumulative sales diversion, the actual bottom line diverted was a measly 129 crores. And I found it very, very reasonable that, you know, their wholesale, their you know, selling operation, their, shall we say, the wholesale selling operation was kind of transferred to Aditya Sales. The actual profit diversion turned out to be very little. Now, you look at what actually happened to the company. The company lost some 50,000 crores of market cap on an issue of 100. In fact, right now we are seeing a similar thing playing out in UPL also, where you know, a very, very small issue.
Rent issue, sir.
So a very, very small issue has been blown up to create massive damage. Now, this is where you know, you have to have an insider's perspective to understand the intent behind what Sun Pharma was trying to do. It was basically a diversion of their domestic sales, and it took, I think, 1.5 years. And today, people have forgotten about it. Why? Because the basic cash flows of the company did not get diverted, and there was no continuing default. It's not a Vedanta. Eventually, after whatever investigation SEBI did, what happened? The real accusation was you did not inform SEBI. So it was just a reporting, you know, problem. And you know, the extent of the fine, which was only about 17 lakhs, tells you what the crime, so-called crime, was. So it was much ado. This is what I call noise. You know, the market gets terribly excited because people slant it one way or the other. A whole short will build up, which we saw very transparently in Sun Pharma just before, you know, the news came out, and the you know, the so-called whistleblower. You found a massive short building up. So it was, you know, it was not insider trading. It was people acting in concert. It was a conspiracy, a market conspiracy, to be differentiated from an insider. So ये कईयों में होता है, Tata's के साथ होता है. A lot of innocents get trapped in these kinds of things. In fact, right now I'm playing UPL with a very, very similar. So these are, I call them free lunches. For those who know, it's very easy to figure out by getting into the management's shoes. ICICI is also an example. I know Sandeep Bakshi very closely because I worked with him in the turnaround of SRF. In fact, for 6 months, Sandeep Bakshi was the owner of SRF. You know, when ICICI bought it out from DCM. So I knew what all he was launching, and you can see it in ICICI. So of course, whatever happened with Chanda Kochar was a corporate governance issue and all that, but it was not a material. See, materiality is very important. Indigo. The battle is about 130 crores of related party transactions in a company that generates, I don't know how many thousands of crores of cash, you know. So materiality, if you can also play these materiality cycles, which are, I call them sentimental cycles. Indigo went through its own cycle, ICICI went through its cycle. So anyway, I'll let Vivek take over from here. But I have lots of questions, Vivek. Maybe we should discuss them offline. I want to debate with you cement, for example. You know, some comments you made about cement. And also Nestle, this high PE, how much of that high PE valuation comes from a different place, currency, and money printing, and has nothing to do with Nestle, let's say.
Sanjeev, it's very good you are sharing your practical insights, and very, very frankly, in fact, everybody would love you to put your video on. You mentioned about UPL, Sun Pharma. Yeah, it's nice to see you on. Really wonderful. Sun Pharma, UPL, both issues you mentioned about the bull and the bear part. In Sun Pharma, it was also a matter of greed. At one point of time, it was becoming the largest market cap company, which of course was not easy to digest from some of the biggies on the corporate sector. It doesn't happen. And ultimately, earlier, it was a very innovator, known as an innovator, fast growing with the support of some of the well-known investment banking houses. But sometimes greed takes over. And the promoters want to milk the company or maybe diversify and have something on the side pocket. Then there was a investigation, as we all know. SEBI did an investigation and minor amounts came out, but it's all about ethics and integrity. We talked about Vivek Mavani contributing on corporate governance, what independent directors can play a role. So here there were issues. And I remember UFOS is a recent example. It happened last year. It was growing too fast and many people had positions and they had a special call where the management themselves came out in the special call. The price had collapsed from 600 plus to around 300 odd, and they were not able to understand the valuation, the multiples of the company to come below 15, below 10, and some of the most agrochemical worldwide companies were valued much higher.
Correct.
Ultimately, as you said, memories are short. 1 month, 2 months, 3 months, and today it is at double the price. And those issues, I hope they are not forgotten. Savvy people like you.
I've gone through these cycles. I mean, SRF is a fantastic example. SRF, I met Kenneth when SRF's market cap was 35 crores. Today it has gone up 2,000 times.
I remember in 1992, we were doing a program of fund managers together, and we had the finance manager of SRF. 92, at that time, it was a small company, and we knew it was recruiting high level, good quality talent. And it would become a mid cap and a large cap one day. And today it is leading the sector. Chemical sector has been a very favored sector in the last 2 years. Of course, thanks to the high incentives government is giving, and also the shift from China. And SRF is leading the rally in the chemical stocks. Some of the finest companies, and also transparent. And it is good to have.
These corporate governance cycles that you're talking about, I've seen this happen across SRF. Well, anyway, SRF is a very old story. Most people will not remember, what all we went through. But, Sun Pharma is recent, and Sun Pharma, the cycle is over. The corporate governance concerns have gone. So what I arbitrage, just picking on and building upon Vivek's point, what I played and I like to play is these free lunches. I call them free lunches because the facts are at variance with the perception. And notice that I'm able to do it systematically. Whether it is an SRF or UPL is an ongoing story right now. I mean, it is happening just now as we speak. That the market has forgotten that UPL is reducing debt by 10,000 crores. How much do you pay for a company that is doing debt reduction of 10,000 crores? Now, that is a fact, and perception will catch up. So I don't care if somebody makes an allegation, especially an ex-wife makes an allegation of some 120 crore rent, against a company. Keep your eyes on the facts. The facts are that 8,000, 10,000 crores of debt reduction will be visible this year. Now, going by normal free cash flow yields, the best confirmation of that will come from the banks, the rise in the credit rating and all that. Now, this is where perception will catch up. You're saying public memory is short. It's not, it's short. It is that as the facts unfold, how long can you ignore that this company continues to pay 10,000 crores of debt reduction and is available at the valuation of a steel company? One day you will wake up कि बाबा इसमें कोई साइकिल नहीं है, इसमें सेक्युलर ग्रोथ है और वो बीवी से लड़ के बीवी तो चली गई. अब कब तक? So it's really not even short memory. It is that the market is smarter than we think it is.
Sanjeev, you are right. There in the market, in fact, there was always a divergence between facts and perception. And we talked about families, the wives, and the families have become very important in the corporate saga. We know what happened in one of the private banks. It was a family-related governance issue. And it is happening in many companies, so that transformation and leadership change and succession planning is very important. We know Reliance last a couple of months back, they are talking about change right away. So leadership planning, planning is very important. And Sanjeev, you talked about Nestle. Nestle was also in one of the slides of Vivek. Nestle also, we have gone through the governance issues. There was a time about 15-20 years back, there was a royalty issue. Suddenly Nestle said we will come at a high degree of royalty. At that time, the stock collapsed from 700, 800 rupees to 500 rupees. On the royalty issue, it came on the cover page of some of the business magazines. At that time, print media was ruling.
You have to
and the royalty issue came, and today it is today 40 times of that. It happened in Maruti also. Governance issue happens, and then some companies listen to the stakeholders, whether institutional holders, FIIs, or the retail people, influential shareholders. They make their voice felt, and the companies, good companies like Nestle's, Maruti, they calibrate and modify their strategies and give sustainable value. I would request Vivek to share the thoughts on Nestle's and Maruti's also. Vivek?
You have to pay attention to the role of corporate conspiracies. You mentioned, corporate rivalries and things like that. Can you imagine that just before UPL results, they will discuss a yacht that the promoters have bought? Now, is that relevant to the discussion of the results of such a big company? Ye news exactly sahi time pe kyun aati hai? And if you watch the price data, you will see the conspiracy. Now, market doesn't understand it. You need to be a very close watcher of these events to see how valuations get distorted. Now, ये UPL में तो अभी continuous है. मतलब आप अगले quarter में आप देख लेना. तो ये तो it's not even in the past. Sun Pharma में तो we are discussing things which in the past cycle is over. Sun Pharma is back to normal valuation. There's no arbitrage there. But इस तरह के जब facts versus perception के जो arbitrages जो खुलते हैं, उसमें a very deep understanding of the facts is itself an asset. That's beyond valuation.
Right. And Sanjeev, we'll address both the points. We talked about Sun Pharma. It is not back to normal valuation. We talked about 1,000 rupees and it went to 350, 70 rupees. But you see the other companies which have galloped in valuation like Divi's, Laurus, it all happened because the gap was there and many companies came forward and grew in valuation much, much above. So Sun Pharma has a lot of catching up to do. It was a leader in over a decade ago, and it left because of this issue. It fell behind, and it is at old around 800. Otherwise, it would have been a 5x of now. Possibly it will now come back. Now they are into too many pies. They went into windmills business, renewable energies business, and also tried to get into property development and acquiring IBC companies. but focus back on pharma would help us substantially. In fact, one of the directors now is more interested in financial services, but focus back on pharma and innovation would help certainly. And we talked about conspiracies. Now we know we are in the age where social media plays a bigger role. So as we mentioned, bulls and the bears. So there are multiple sides to it. And these things often get multiplied at a certain points of time. So people use this thing, why not? Ultimately, people have to deep dive into it like we are doing today, get into the serious issues. And if there are conspiracies which are not valid or just to bring down the prices, it can be a big opportunity. Sometimes conspiracies work and some people partner with it and bring down the promoters. We know corporate history is very important. In some cases, conspiracies have worked also. Where the CEOs had to resign. Management changes are there. But sometimes there are flimsy conspiracies to bring down the prices, and sometimes the same bears may buy. But this becomes a good opportunity for many people to understand the conspiracy, which is not easy also and not that difficult also, and identify the facts, look at the facts instead of opinions, do deep dive into it. And once you know the valuation game, how it pans out, and also if you are good at crunching data, and lots of data is available, and ultimately make the bets based on proper knowledge and using the experiences of experts, it will be really wonderful. Mr. Dushyant, you are there? Aryan?
Yeah, Manoj, I'm there. I'm listening.
Yeah. Yes, sir, I'm there. Put on your video on your thoughts on Sun Pharma, Nestle's, and also governance issues. I would mention Dushyant has been on the board of joint ventures of HPCL and gas companies, rich experience in finance. And then after Dushyant, Aryan, your thoughts, you are planning to share some thoughts, you raise your hand. Yeah, Dushyant.
Yeah, talking about Sun Pharma, I think the perception, the corporate governance issue and the perception has possibly left the company, way behind. And even if they are now out of that, and but the total focus is shifted to other companies like Divi's Lab and Dr. Reddy's and all that. So naturally, it's like the investors, preference, which works also. And talking about other companies, the governance issue definitely plays a role. But as it was mentioned that, the arbitrage, the person has to be more information savvy and able to analyze what is the real fact and how much it is going to impact the valuation. So that is very important. But ultimately, it is the market price which drives the whole thing. So whether we know rightly or wrongly, what happens in the market is more important.
Yes, Vivek. Vivek.
Sir, I think Vivek has left. He has dropped a message, I guess.
Krishnan, we are video on.
What Mr. Pandya has to say about this?
Yes, sir.
Nothing. I just, I mean, while I take the point that.
Can you put on a video, no?
While I take the point that one sec. While I take the point that relative to other people in the industry, let's say a DVs or whoever is the latest, fad in town, Sun Pharma may be ahead or behind. That as an investor to me is not a very important thing. What is important is that I got Sun Pharma very cheap. without putting in much effort. And I got a near guarantee that the market is wrong in what it is saying. So I took a view on that. What is important is that I got 400%. Now, you play such things with leverage and you can, and I do it with very, very concentrated positions. So it's very easy to outperform when you know that you are right and the market is wrong. Then you're just waiting for the market to catch up. I did the same thing with, let's say, with Tata Steel. Now, it doesn't matter to me that Tata Steel is at a lower valuation than JSW. It's not the valuation race that I'm playing. It is the valuation arbitrage. So fine, divis is another story. Maybe I could have seen it. I cannot be following all horses. What is important is that, did I get a free lunch or not? So if the point of the presentation is how do you arbitrage your own track record? And as one of the strategies, if you can locate these valuation arbitrages, they are a good thing to play. Like I gave the example of UPL just now. That imagine getting an agrochemical company with a long-term, registration list and debt reduction, blah, blah, all at 6 to 7 times EBITDA. With just the debt reduction is giving me a 30% margin of safety. Tomorrow, I will not be surprised to see this company at 10 times, 12 times, 15 times EBITDA. So I'll get a valuation kicker besides the earnings growth of 20% that the company is secularly giving. Now, you just imagine what kind of arbitrage we can get when we play these cycles. Now, this is in addition to just the static valuation numbers that Vivek was talking about. Sometimes you get these soft things which can translate into an investing strategy on its own.
And then in that case, what you have to talk about ITC?
Yeah, similar. Oh, fantastic example. Yes, I am a big, passionate, today I'm saying that ITC's FMCG turnover, if I remember, is marginally above Hindustan Levers. Okay. And according to me, this is my version of the story. It is not the jokes that you will find on WhatsApp, for example. So it is contrary to those jokes. Now, if you are getting India's biggest FMCG company with a marginally lower, EBITDA by sales, but an equally good EBITDA by asset, okay, 30% or whatever, similar growth trajectory hidden inside a tobacco company. Okay, now from a sustainability angle, I would say that ITC's FMCG business is more sustainable than Hindustan Lever, just my opinion. Why would I pay 65 times earnings for Hindustan Levers when I can get such an FMCG company with the protection of the cigarette business at a valuation that is 13 to 14 times? What a massive arbitrage. So, but what do I have to, live with? I have to live with the current market perception. I keep wondering who is funding all these jokes that you see on WhatsApp. Somebody with a vested interest.
It's a social media opportunity.
Yeah, no, somebody, I always imagine R.K. Damani, paying some ad agency to keep floating these jokes and keep, depressing the perception about ITC. It's a fantastic company protected by a massive cash flow, which is not degrowing the way the market perceives it. Market is wrong everywhere. And I'm getting this company at a 6% dividend yield. I could replace it with a bank deposit. Now, if you play that correctly, and it'll become a complicated discussion if I get into all that, hello, same hacker.
No,
it's not hacker.
Don't worry. Don't worry. India is far ahead than the Chinese in technology. Acha, Sanjeev, you talked about ITC. And also, it's the intrinsic valuation and the jokes. Your thoughts on Adani Group and the valuation?
Oh boy. No, that is where I'm a conservative person. I like to get into the promoter's shoes and look at the business. I don't like people that are hyped. So I don't know too much about the Adanis. I mean, I have not been tracking them. So I honestly don't have enough data. But ITC I've been tracking very, very closely, and I can see clearly a valuation arbitrage. See, you can you know, we all get into investing hoping कि आज 100 रुपए का खरीदेंगे और कल 200 रुपए का हो जाएगा. How about a guy who says आज 100 रुपए का रहे, 10 साल तक 100 रुपए का रहे, और फिर 10 साल बाद अचानक से 200 रुपए का हो जाए? I would rather take that. क्यों? Because I love the money I have not yet invested. अब ITC वहां मान लो पड़ा रहेगा और मैं बैंक डिपॉजिट में कहीं और से यूपीएल से कहीं से अपना कमाता जाऊंगा and I will keep bunging it into ITC. And tomorrow I get a multi-bagger. So I'm more concerned with my compounding rate and not the company's compounding rate. So I don't like hyped companies. I mean, last year we were having this debate about Hindustan Lever versus ITC. I was saying I'm paying 5 lakh crores for a 50,000 crore rupee company in HUL, and here I'm getting the same company for 2 lakh crores with the protection of a 1,80,000 crore cigarette business. So
HUL was 900 rupees 3 years back. It went up to 2,700. Today it's around 2,300. So what do you say that in 3 years ITC made no progress?
No. So fine, exactly. So that's my counter argument. What kind of people bought HUL? If I think that they are foolish, if I think it is free money, if I think it is basically wo zero debt wala US ka paisa, so it will all move with interest rates. So the quality, I'm not racing with the people who got into HUL. Fine, if you were an early entrant into HUL, you're welcome to your. I am looking for a free lunch.
Sanjeev, there was a time, a decade, when Dadi Seth became the head of Lever. Lever did not perform for a decade. Yes, and then a catch-up happened in the next decade. It made enough return to be over 20% CAGR. Exactly. So there are lags in the market. There was a time Reliance Industries, 7 years, it did not perform. It underperformed not only in the Nifty, it underperformed the petrochemical sector also. So
I love stocks that are not moving. I am very sensitive to perceptions. I call it the disgust factor.
So Sanjeev, you are a very patient man. You have a lot of patience, right?
No, it's not just that. It's because, the non-moving train will move suddenly.
And
the moving train,
can you predict when the train will move?
No, I am not interested. You know why? Because as a derivative trader, the longer that you think of me as a guy who's selling chinia badam on the stationary train. Now, on the moving train, I could get hurt. I'm very sensitive to the probability of getting hurt. बाकी मेरा चिनिया बादाम बिक रहा है ना, तो मेरे को ट्रेन से कुछ नहीं लेना देना. I'm not even interested कि ट्रेन कहीं जाए.
So I'm very happy. Yeah, a moment depends on the driver, and we will see what Adani is driving ahead. There is an IPO on Adani Wilmar. Are we ready with the data? Manish?
Yeah.
Let's start the presentation on Adani Wilmar. We'll do deep dive, 7 listed company, and then we'll have a much more interaction on groups and many more. Yeah, let's start the presentation. A deep dive into the RHP, which is over 400 pages on Adani. Then we will have a discussion on Vedant Fashion also. It's a brand supported by Kedara Capital, and how they are planning to transform the branding and valuations of brand company.
Manoj bhai, Milan Shah here. Can I come in for a moment?
Yeah, certainly. Put your video on. We have been looking forward to you. Till the presentation starts. Milan, congratulations for being taken on board as a Tata employee on board the Tata family. Milan is a veteran in working for Air India, which has been India's topmost pioneering airline.
I would like to, just have a discussion with Mr. Sanjeev. I found his views very interesting. I think we should have one session by Mr. Sanjeev himself, on his views and his philosophy. There's a lot of things to learn from Mr. Sanjeev Pandyan. Hello?
Yeah, definitely.
And whether he has any views on Adani Wilmar IPO?
No,
I don't. Sanjeev to get a view after the presentation. let's see the facts.
Adani has been in my blind spot. I haven't,
We see the data and the industry study what is about, and then we'll discuss the views. Let's see the data.
So I look like, I tell you, Sanjeev ji, Adani Wilmar will become #1 company in FMCG in oil space, basically. I see it after 5 years, definitely.
Let's have the data, then we'll form.
Let's have a data. I agree with you. So today I'm just starting my presentation. We will have some discussion on IPO of Adani Wilmar Limited. So 1 minute. Okay. This is our details of our core group team members. This is our disclaimer that we are doing only for education purpose and no commercial angle is there. We are not registered anywhere. So please take your own decision. Here we start our presentation. Our company name is Adani Wilmar, based in Ahmedabad. Company has two promoters. One is Adani Enterprise and another is one Singapore-based company. This company was started in 1999 as joint venture between Adani Group and Wilmar Group, which is Singapore-based. This is the FMCG food company offering most of the essential kitchen commodities for Indian consumers, including edible oil, wheat flour, rice, pulses, and sugar. Company has a lot of a diverse range of industry essentials like oleochemicals, castor oil, and de-oiled cakes. Company has a 3 kind of portfolios: edible oil, packaged food, and industry essentials. Fortune is the company's flagship brand. We see Akshay Kumar on the advertisement of this company. This is the largest selling edible oil brand in India. Recently, the company has focused on value-added products and has launched products such as edible oil products, rice bran health oil, fortified food, ready-to-cook soya chunks, khichdi, etc. in line with this. The company has a whole new kind of business. These are the details about the company. The company is operating in 22 plants located across 10 states in India, comprising 10 crushing units and 19 refineries. Refinery means oil refineries. The company's refinery in Mundra is one of the largest single location refinery in India with a capacity of 5,000 metric ton per day. In addition to the 22 plants, Adani Wilmar also used 36 leased units as of September. Company's distributors are in 28 states and 8 union territories throughout India, catering to 1.6 million retail outlets, that is 16 lakh retail outlets. As of September, the company has 88 depots in India with an aggregate storage capacity of 1.8 million square feet across the country. That is 18 lakh square feet of the aggregate storage capacity. There's a long list of competitive strengths. As we know, Adani, so nothing to discuss on this slide. The IPO is coming on 27th. It started on 27th and last day is Monday, 31st January. I think it's already subscribed by 2 times. Company, see, this is the company, though IPO size is 3,600, there is no offer for sale. Company is basically funding the capital expenditure for expansion of existing manufacturing facilities, repayment and prepayment of borrowings, funding strategic acquisition and investment, and general corporate purposes. Pre-issue holding of both the promoters is 100%, and post-issue holding, it will come down to 87.92%. Face value is 1 rupees per share. IPO price is 230 per share. issue size is 3,600, which is a fully 100% fresh issue. One can invest 65 shares at 230 rupees. So one has to invest 14,950 rupees minimum application to apply. QIB share is not more than 50% of the public issue. Retail shares will be not less than 35% of the public issue. And high net worth shares offered is not less than 15% of the net issue. This slide shows us the funding, how they will use the funds received from the IPO. They will use the funds from fiscal 2022 to the fiscal 2025. Roughly first 2 years, they will use 2,700 crores they will use in first 2 years, sorry. This is the past performance. Company equity capital has remained same.
Sorry, Manish, sorry to interrupt. Can you show the previous slide?
Oh, yes, sir.
Yeah. This capex capital expenditure. Interesting to know that they are raising the full money now, but they are going to spend a major part in the after in the next 3 years only.
So if you see, we are into fiscal 22. Suppose they will get money in February, right? Example. So they have 11 months in hand of 7 months. Rather, see, if you see out of 3,600, almost 1,000 crores they are making payment to the borrowers. I mean to say they are repaying the debt. So वहाँ पे उसको 100 crore का saving हो गया straight forward. 150 crores they will buy a new acquisition in current year. 100 crores they will put in they will do an capital expenditure in current year, which is a normal one. So out of 3,600, they will roughly use 1,250 crores in current year, and roughly another 1,200 crores in next year. You are right. And
so they could have come out with a partly paid issue.
नहीं सर, फिर उसमें estimate listing नहीं होता है ना सर उसमें. See, the major purpose is listing and valuation, right? Why somebody goes for public issue? Just for the listing and just for a better valuation. Correct. Shall we go ahead?
See, I don't know. Partly paid का भी तो होता है ना. Partly paid also.
उसमें valuation नहीं मिलता है ना. Because promoter अपने shares का valuation नहीं मिलता है उनको. See, मैं आपको बोलता हूँ दर्शन भाई, कभी भी IPO never comes partly paid. It has always come equity shares. So that is why I fully agree कि अरे सर इतना बड़ा कंपनी है तो हर साल कुछ ना कुछ तो कैपिटल एक्सपेंडिचर होएगा ना सर. 100 crore per year capital expenditure is nothing, right?
Yeah. So that normally these companies, such big companies, they spend out of their internal resources.
Sir, you will get your answer in one of the slide when we come to capacity utilization of this particular slide also.
Okay, fine.
Yeah. See, this is the past performance. Company's equity remains 114 crores and net worth as on September is 3,651 crores. Total turnover in current year is approximately 24,000 crores for the first 6 months. So we can assume fiscal FY22 turnover would be more than 45 to 50,000 crores, in between somewhere. And profit is also good, highest profit in current 6 months. If you see, net asset value is as on date is 32 rupees, and company's total borrowing is 1,944. यहाँ पे भी एक catch है, which we will discuss in the next slide of debt equity. So this is what slide shows debt equity. Company says current borrowing is 9,235 crores. And current equity is shareholders fund is 3,651 crores. So if you see the debt equity ratio comes 2.53, whereas in the slide above, company shows debt is actually 1,944. See the difference. Why this difference is there? Because company has taken a bills payable facility, which is called acceptance in a books of roughly 7,500 crores or 7,200 crores. So that acceptance is payable as on date, which is a part of debt. So here in this slide, it shows borrowing is more than 9,000 crores and debt equity is 2.53. इसका मतलब ये है कि company is importing lot of material. If we say companies turnover, creditors turnover say of 4 months, roughly 3 times in a year, then company is almost doing more than 50% material company is buying from overseas, which is also a long term it is not good because always rupee will be depreciated. Correct? Shall we move to next slide?
Yeah.
Sir, nationwide presence बहुत बड़ा है ये company का. This is the nationwide presence for all manufacturing activities. You see, company has a plant everywhere across the state, so it is saving lot of money in logistics. Basically, it is it is very easy. But major plants are concentrated in Gujarat, Madhya Pradesh. Maybe basically because agriculturally they may be getting a good amount of raw material. That could be the reason. So this slide shows very good, sir. That company has developed its manufacturing capabilities all across the whole country. Another slide shows marketing network. They have all these different distributors across the country. Like centrally, they have 807 distributors. They have in West, they have 1,000 distributors. In in North, they have 600 distributors. In East, they have 900 distributors. So that way, they have over the years they have developed a good marketing network. Sir, this is the Dushan bhai, आपने वो जो सवाल पूछा था ना कि where money will be used. So here answer यहाँ पे है. Installed capacity, actual production, and capacity utilization. I have taken a figures of only 2021 financial year. If you see that crushing capacity utilization is only 25%. Refining capacity is only 55%. Packaged food is 39%. And oleochemicals is 65%. Oleochemicals comes under industry segment. So this company has a very low capacity utilization. Still, company says we will have a more acquisition in future. We will have a capacity utilization in existing facility. So one thing is very good that company, if company market goes up, rather sales goes up, it has ready-made capacity to increase the production, ready-made capacity for a more sales. So this is the reason I would say that the company definitely will become number one in FMCG for specifically oil and refining products. Any comments on this?
I think there is a lot of competition from ITC, Marico, and all these other companies.
Definitely. Marico is the bigger competitor for oil segment, basically.
Yeah.
Definitely. What is the EBITDA margin? I mean, on sales currently, the consolidated. And what is the market cap? I mean, what is the listing market cap?
Listing market cap I have given in the another sheet. I will come to that, sir. Sorry. If we see that their profit after tax is roughly, 15%, 12,
No,
13%.
EBITDA, because interest is.
Actually, I have not calculated EBITDA, but I see EBITDA is at least 30-35% EBITDA is there, sir. Definitely. Looking at the, net profit margin.
No, it cannot be EBITDA so much. Just recheck the RHP. EBITDA is not in this such type of companies. It will be much lower.
And interest would not be, 35% of 24,000 crores would be about 8,000 crores per quarter. Unlikely, because, EBITDA should be closer to 3 to 5%, not 35%.
Sir, आप देखिए ना, yeah, you are right. EBITDA may not be 35%. It will not be more than 7 to 8% in any case. Right. Correct. 100% correct. But actually,
gross margins would be much higher, but EBITDA will be lower. Gross margins will be in that range where you mentioned about, no?
Yeah, correct. I fully agree. Sir, one thing, acceptance, they may not be paying any interest, because interest must be bearing by the, creditors.
Acceptances are very likely to be buyer's credit, which will be, they would be having, good forex exposure and therefore forex risk. Usually these kind of companies suffer when the rupee suddenly depreciates, and they do well when the rupee, currently the rupee is in an appreciating mode.
Yeah.
But the key margins that they get comes from the fact that they do not hedge their overseas risk, their FX risk. This 7,000 crores that you're talking about is probably buyer's credit, which is coming at, say, LIBOR plus 30. So it is coming at LIBOR plus 0.3% or something. And about 4% of hedge cost is missing. If you gross up that, then the EBITDA margin will fall. So there's a massive, what should I say, FX risk that the EBITDA is exposed to. So anyway, that is just one issue that I'm flagging.
No, that is the correct issue actually, because this kind of, I have worked in this kind of companies where a lot of buyer's credit was there, and suddenly rupee was depreciated and a lot of money has to be paid extra. Correct? Agreed, fully agree.
So right now the IPO, it is sensible to take the IPO proceeds and put it into covering your FX risk. So that is a good place to park your money. It's basically like buying dollar assets. But only thing I wanted to understand is what kind of multiple am I paying for this kind of company?
That also we'll see in the next slide, sir. Coming slide. Sir, this is the comparison of peer companies. If you see Hindustan Lever, PE ratio is 68, Britannia 44, Tata Consumer is 81, Dabur is 62, Marico is 60. So roughly 50 PE ratio, Adani will also maintain probably. And it's a profit-making company. So if you take a EPS of 6 rupees per year and 50 PE ratio, listing price can be around 300. This is my understanding.
No, but EBITDA. I was just, not PE ratio, I was just looking for EBITDA multiple.
I will see the EBITDA multiple. I have to check the RHP. Let us complete this. We'll check RHP also. No issue, sir. This is the net asset value. Net asset value is around 28 rupees right now. So it's a price to book value is around 8 times. Whereas other companies in the same segments like Gujarat Ambuja, Agrotech, Hindustan Lever, Marico. So the main competitors are Marico. Marico is having price to book value is around 15. So 230 issue price, I look at it a proper price compared to the other companies in the same segment. So this is the data on return on net worth. Return on net worth as on 2021 is around 22%. Whereas other companies like Ruchi Soya is 17%, Hindustan Lever is 29%, and Marico is the highest, which is 36% return on net worth. So this data also shows the company is doing proper working. This is the data of earning per share. Company has improved earning per share from 2019 to 2021. average cost for the promoter, average cost for the promoter is for Adani Enterprise, it is 12 rupees. And for the other promoter, it is just 6 rupees. Because company actually from 10 rupee to 1 rupee में bifurcate किया था shares को, and company is issue price is around 230. So if we roughly market capitalization is around 29,000 crore as on date at the issue price. What there are though there are lots of competition in this segment. If you see, edible oils market has grown from FY25 from 1 lakh crore, it will grown to 1,56,000 crore, and the estimation is there that it will grow to more than 2 lakh crore in 2025, which is just 3 years ahead from today. So company is banking on the market growth, consumption growth of all the edibles oils or other staples like rice, wheat flour, etc. There is a good growth of consumption in India. This is what competitors do and what Adani Wilmar is do. Adani Wilmar is in all the segments like edible oils, wheat flour, rice, pulses, sugars. Whereas only Patanjali is the main competitor which are doing all this work, all these segments. Otherwise, if you see, HUL is only wheat flour, ITZ is also only in wheat flour, Marico is only on edible oil, and Imami also is only on edible oil. So Adani Wilmar has an edge over all the competitors related to products. So this is what key pairs financials for last 2-3 years like FY15, FY20, FY21. If you see that the main competitor is Marico. Marico is just 6,000 crore turnover, whereas Adani Wilmar is 37,000 turnover. So there is a big difference. Only ITC and HUL both have a higher turnover than the Adani Wilmar. And the CAGR growth is, EBITDA CAGR growth is much higher. So Adani Wilmar का EBITDA is 1,400 crore in FY21. Sanjeev sir, आपने सवाल पूछा था ना?
On EBITDA.
Yes.
Yeah, got it. So that means, I mean, if we take that listing price of 30,000 crores,
okay,
this is coming to me at 20 times EBITDA, right?
Oh yes. Yes.
I think that is pricing in the high growth in turnover, which has been happening in FY22, and there are reported plans to add a basket of products. So a few years.
Sanjeev sir, EBITDA और market capitalization को क्यों compare करते हैं?
नहीं क्यों? That is the normal. I mean, that tells me what I want to pay. Basically उस EBITDA की quality को देख के और उसका reinvestment देख करके I have to judge whether I am going to get a decent return on capital.
Yeah, certainly. You have a valid point. Market cap is very important. May I know who is speaking? Is your video on?
No. My sorry.
Sanjeev sir बोल रहे हैं.
Your name and
Sanjeev sir बोल रहे हैं भाई.
Sanjeev Pandya.
Yeah. Okay. Yeah.
So 20 times EBITDA, what should I say? It tells me the caste rating of the company. So 20 times EBITDA, by caste rating, I mean, अगर ये steel company होती तो I would have, looked for 4 to 6 times earnings. अगर ये pharma company है तो I will look for say 12 to 15 times EBITDA or something like that. So अलग-अलग caste होती है based on the quality of the cash flows that you have.
Sanjeev, what EBITDA you should give to such a company, this profile?
Oh, that's a very loaded question. I'm an outsider. I'm not, so I don't want to classify this across, but I have my issues. I pointed out one of them. that a large part of the company's margins comes from the edible oil arbitrage that comes from, buying something overseas, taking a big FX risk. So I will not rank this EBITDA on par with, say, an HUL EBITDA. An HUL EBITDA is domestic sourcing, an ITC EBITDA is domestic sourcing. This one is overseas sourcing, so it is risky. Now, if you're not taking, that FX risk, which is what the company is planning when it, it is wanting to pay off its acceptances. Agar company kuch na kare aur IPO succeed ho jaye, तो जो रिडक्शन इन रिस्क है कि इनका जो एफएक्स रिस्क है वो खत्म हो जाएगा, that itself de-risks the company. I'm saying this as a CFO. That doesn't mean that the investor will be happy because he's not getting a huge compounding. So as far as multiples are concerned, this is an investor's perspective, very different from a CFO's perspective. So 20 times EBITDA, is it like pharma? I mean, pharma it would be at 12 to 15 times EBITDA right now. And
but pharma to EBITDA always good because they have a good margin, 30-35%. So definitely their EBITDA compared to max market cap would be always lower.
In case mein, you should not be looking at their EBITDA on sales. You should be looking at their EBITDA by capital, because their throughput, the sales by asset is very high. They would be turning their assets around by 3 to 4 times per year. So when you see a 3 to 4% EBITDA margin, you should actually be looking at 12 to 15% EBITDA by capital employed.
Now, you mentioned about the forex exposure. These companies in the industry, whether it is Adani Wilmar or other companies, also their forex risk is usually hedged.
No. If you hedge it, these companies, if you look across the industry, usually, I'm talking about old data, usually these hedge costs cannot be recovered in margins.
And this is prevalent in the whole industry. They often pass on the higher cost and they come with a lag. And incidentally, one more factor, particularly the last few years, the rupee has been very strong. So earlier there used to be devaluation of the rupee regularly. So there was a cost escalation. Now rupee has been quite strong in the last 2 years. Last few years. Another point is also looking at the EBITDA. This company is actually looking at high growth in the basket of products. It is as aspirations to offer most of the products which you are using in the house. Practically over a basket of 20-30 products, practically everything which you want to use, the way Patanjali has been now becoming a leader in the space. It's a huge opportunity. Earlier it was levers, then ITC entered, Colgates. Today, even just in toothpaste, Patanjali is growing by leaps and bounds, whether it is Atta and all. So this is a space Adani has to capture, and what Adani Wilmar is talking about, they are really converting the unorganized sector into organized sector. Huge potential to grow, to offer quality at value.
So that is the story that people have to buy. I mean, this what if all this turns out to be correct and Adani gains market share, etc.
Yes, exactly. Talk about market share in the organized space, and also we talked about FMCG sector. Generally, those companies are growing in double digits, or in the beginning of double digits, in 10 to 12%. The way Adani Wilmar has been moving as per the RHP which they are given is growing at a high percentage, and if they continue to grow so much, then that's why they are trying to justify the high multiples. Of course, the multiples here are often taken on the basis of the efficiency of capital, because this business is all about managing your inventories and distribution chain. Like Hindustan Lever is known for negative working capital.
Correct.
That is why you have high multiples.
Yeah, correct.
Hindustan Lever, Unilever multiples, particularly of the Indian company are mainly because of negative working capital. They get advances from the distributor, which very few other companies are doing. ITC has that advantage. They would also do. But most of these companies, if they want to grow, working capital needs to be managed very, very efficiently. And pricing power are in the brands like Hindustan Lever has a lot of brands. ITC is building up a lot of brands. And often when you go to purchase that oil, you have multiple oil opportunities, brands on the shelf. They actually are not really, they are considered as commodities or packaged commodities. Some companies like Godrej and Marico's, Safolas, they have built up a brand by identifying the product with a certain profile of customers, quality like health, diabetes, etc., etc. And Godrej for the trust it has got. Yeah, here you have a lot of brands, but often we have seen in this product profile, people go on the supermarket or order from the Karana. They often go for the product which is available cheaper. And Dara also is available at a value price, but the distribution of Adani Wilmar, they claim in their roadshows is very, very strong.
These are the brands operating in India, different company, different brands.
Yeah, and the different range of products. That's very
different
important.
range of products.
Yes,
Definitely.
yes, yeah. Come to the different range of products, and the company is willing to fill in the gaps in the product categories and the customer segment it is. If the customer wants to, same customer wants to buy, so why buy of the other competitor if the company can offer? So this will give them scale and leverage the customer's advantage who already likes the Adani Wilmar brand. So very, very important and clear. And now the point is how the IPO would do on listing and post listing. I think the company is saying is going to be the 7th listed company, right? And so far, Sanjeev, you mentioned a certain caste and a category is assigned to the promoter.
No, not promoter, the company, the business.
And the business.
I'm saying that a steel company is different from a pharma company, is different from an agrochemicals company. Obviously, promoter also plays a role. If it's a Tata company, for example, I'd value, let's say, steel. So I had a difference of opinion on Tata Steel. I made a very famous presentation in 2018 on this, that there's a valuation premium to Jindal. Now, I've been a Jindal CFO. I know the group, very well. And then there is a Tata company which is available at, let's say, a valuation discount because of its global business. So again, I played that cycle. So everywhere I look for, so my style is that I look for a free lunch. It has to happen. It has to be based on facts. So if there is a Tata company which is available at 1/4 of the valuation of a Jindal company in basically the same business, because of an overseas, overhang of chorus and all that, I know it's going to work itself out. And I turned out to be right. The valuation changed by 400% within 2 years. So these kind of valuation arbitrages, Sun Pharma was another, example that I gave. Right now, I'm playing, let's say, UPL, which I think is a 12-time EBITDA company going at 7 times EBITDA. That kind of valuation arbitrages. So similarly, ITC was a fantastic example where I think that a good FMCG company or a good infotech company is hidden inside that and is literally available to me free of cost.
And anybody who looked at Adani Wilmar should, as you suggest, should look at ITC also. And Sanjeev, it's interesting that you're looking for free lunch. And not only today, you have been looking for it for a long time.
Well, 25 years.
Let me tell you, in markets, there is no free lunch.
I am managing to.
You pay the price, and in companies like ITC and earlier, Colgate also for a long time. There was a time when the Colgate was available at 6 to 7 times of advertisement expenditure multiple. when Pepsodent was damaging his pricing power. So it really happens. But when you are looking for free lunch, then you have to, the cost you have to pay is the time. You have to have a lot of patience. Ultimately, somebody gives you the free lunch.
Yeah, I mean, and I mean, ITC, when it had its excise duty case, it fell 80%. So those are the free lunches where I'm calling them free lunches. It's basically market inefficiency. When the market turns inefficient, data that the whole market is looking at, I'm also looking at the same data, but I see that there is an arbitrage available, and then I play those arbitrages. And usually I look at an arbitrage with a 5-year horizon, but I get it in 2 years. So
that's really good. 2 years is lucky. You get arbitrage, and arbitrages are really good opportunities. But we have to say that there's a risk in arbitrage also.
Sure.
But one may have to reverse it. Now we'll come to Manisha. Just come to the cover slide or the presentation.
Yeah.
And Dushyant, you are there, Dushyant?
Yeah.
Dushyant, there is another IPO coming where the roadshows just started yesterday. Very, very important in Adani Wilmar, we talk about brands. Now another IPO, brands, this is for the roti and food and hygiene, and another IPO, Vedant Fashion. Much again, look forward to IPO. Markets have improved, and this is celebrity wear, celebration wear, right? Attire. Let's have a few thoughts from you on Vedant Fashion's IPO.
Maneuver.
Yeah, maneuver. Then we'll have a round. Dushyant, first some insights from you.
Yeah, the thing is, this IPO is really coming out, after popularizing their two major brands. One is Maneuver and another is Mohe. So, maybe due to the popularity of the brand ambassador or whatever, and the youngsters are liking these Maneuver, clothes very much. And, the convenience is that if you are not able to get...
Dushyant, put your video on, no? Your video and on, hopefully.
1 minute, huh?
Yeah. So everybody can see you while you talk.
Okay. So, in the younger generation, the Maneuver brand has really, got acceptance. So, so to say, the brand positioning is quite good. But the whole IPO is totally OFA.
Offer for sale.
Yeah, it is an offer for sale. So, whatever you analyze for the company, but the money is not going to go to the company. They have got a lot of spread across in the width and breadth of the country. But just before that, talking about the issue size, it is about 3,150 crore issue going by the upper end of the price band of 824 to 866. So something
very costly.
Yeah, very costly pricey issue.
Yes, 100%.
Yeah, and
बजट का टाइम देख के उसने मार्केट अच्छा होने का एस्टिमेट करके पब्लिक इश्यू लाया है उसने.
But you have to look at the company and the brand value. Let's hear what Dushyant has to say. The EBITDA is very, very high in this company. Right?
Yeah.
EBITDA is over 40%, 48 to 49%.
Yeah, let us understand what exactly, the company is, generally the information. And now the two major investors are selling out. The promoters are not selling out much. The promoter, the Rhine Holdings and another Kedar AIF. These two are selling out. Yeah, Kedara AIF is selling out, and the promoters trust is also selling out certain shares. So basically, there are three entities which are selling out the shares. Now, the issue is, 35% is available for the retail investors and 15% for the HNIs and all, and 50% for the institutional investors. So there's so far about the issue details. Now, talking about their total, the spread about the these companies, marketing strength. They have got something like a retail footprint of about 1.2 million square feet, covered under 535 exclusive, brand outlets, 535, and spanning across about 212 cities. So it's a very fairly good spread of the, brand and the retail reach. And, and they are also having certain branches, EBOs in the overseas also, like in US and Canada and UAE. So that is what their overall reach about the retail, marketing and all. During the previous financial year, the company had a revenue of 565 crore and profit of about 132 crore. So this gross profit margin is quite good. And for the first 6 months of 22, the company had a revenue of about 360 crore and a profit of about 98 crore. So the gross margin is really good. And the company suffered certain revenue losses in the pandemic year, but otherwise they are now picking up. And if you see the, the revenue part, so in the 2000, year ending March 20, the turnover was something like 915 crore, whereas in 21 it was 565 crore, something like, about 25 to 30% drop. But now they are catching up because in the first 6 months it is 360 crores. So they are much better, compared to the previous year. And the gross margin is also around 66%, which is very healthy. And it has been very steady, like, in March 19, it was 65, then March 20, it was also 65. And March 21, even though the revenue was down, the gross profit margin is about 66%. And even for the first 6 months of this current fiscal is also about 66%. So it's a decent gross profit margin. As a result, the EBITDA is also about 49%, which again is increased over the period, and it's now around from 42, 43 to it has gone up to 49% in last 3 years. PAT, talking about PAT, the PAT margin also is about 27%, which is the highest in last 3-4 years. From 22 to it has gone up to 27%. Return on capital employed is slightly lower for March. It is 34%, but earlier previous 2 years it was around 48%. Hopefully this current year they will pick up. So overall the business is doing well. The profitability is good. However, as Manish said, the valuation is a little steep.
तो ये इंडस्ट्री में क्या होता है मालूम है आपको? ये जो ग्रॉस मार्जिन आप बोलते हो ना 66% है, अग्री, बट इफ यू कीप 100 पीसेस इन शोरूम और अगर आज रोज का 2 भी नहीं बिका ना सर, तो ये दे मेक अ लॉस. तो ये रिस्क ये बिजनेस में बहुत है दैट वे.
But talking about these fashion and these the ready to wear business, it always happens that way. Whenever you also go, you or me will go to the store, then definitely there will be certain pieces which are not going to be sold. So there will be some kind of a working capital investment, but whatever are getting sold, they are at a very huge margin. So they make up for that. And
correct.
Let's discuss the SWOTs of this company. What are the strengths? Now, from what Dushyant, you have pointed out, the company has an excellent suite of products, and also a major strength is the data analytics they are using, and also providing the product to the customer at the right time. Now, particularly they are into celebration wear. In fact, it is interesting when the company is looking for valuation, they are looking at the whole market of a celebration, whole market for wedding. In fact, in the roadshows, they are also talking about in the pandemic, how many people are attending the wedding and how many young populations are there, and also the likely marriages to happen. This is the approach of the promoter. It is, somebody will say it's a Dukandar model. Somebody will say it's a franchise model. But Dukandar model doesn't get this valuation. and the franchisee model also doesn't get these type of valuation. So the company is looking at as a brand, national brand, global brand, and also use of the best technology to grow. So this and also a process-driven business, they are working like MNC. Normally, dukans or the shops, they don't work like MNC. Now, somebody has mentioned there are other brands also like Raymond's in the textile space. But the company in the road shows is comparing itself with the topmost brands. They are looking at comparing with brands of Levers and Dabbers and Maricos, Titan. The company is comparing with the Titan brand, although there is no comparable. So they are looking at this valuations. Titan has built and is valuation due to the trust and brand and the huge network. So companies looking at is quite surprising. Looking at valuations when you are comparing Vedant Fashion, Manevar to Titan, it's surprising. It's they are looking at it as a strength, and of course this would be driven by the insights Kedara Capital has brought in. You look at the qualifications of the promoters, they are not biscuits with MBAs from the Ivy League university. They are just graduates and from the eastern region.
Yeah, it's Kolkata based.
Yes, they are graduates from the eastern region. Two of the promoters' profiles are being used, but the point is they have they are listening to the insights brought in by the private equity investor. I think it was mentioned they are selling a stake, and maybe the remaining stake may be free. But and using the insights to grow, develop processes and efficient processes, and build a network, a franchise network. Most of the stores are franchises and also going global. They have a pan-India reach and also present in US, Canada, etc. Lots of omni-channels, strengths, and they are looking at opportunity which we discussed, the huge celebration market. Anybody wants to celebrate, they want to target that customer who can walk into the store and get the product. And when you are going in for a celebration, which happens maybe once in a few years or once in a lifetime for some, and people are willing to pay the price, it's very, very important. That wear is very important. So that is a huge opportunities. So strengths and opportunities. Now, Manish, you are talking about the weakness. And
Manoj sir,
and also we have to look at the threats. Yeah, Krishnan. Yeah, would like you to mention the each part. Would like you to say whatever you are aware of. SWOT, opportunities and threats.
Typically, I may not buy this product frequently. That could be a drawback. That could be a drawback also, because repeat purchase may not be there.
Certainly, you can buy the Adani Wilmar product frequently. Frequently, so you have that option of IPO also, and you have an option of a celebration where IPO also. So frequent ones can go to Adani Wilmar, different type of EBITDA, different type of growth, different type of pedigree of management, and here different type of EBITDA, a low EBITDA in Adani Wilmar, and here this is among the very few companies which has a 49% EBITDA.
Hey, I have one
so that's why you are willing to pay much more. It's not a few hundred rupees. You are paying a few thousand rupees, and today people pay more than 10,000 rupees for the celebration wear. There are some who even pay more than a lakh of rupees.
Yeah, definitely. No, but the challenge is today, if you see, actually Van Heusen is trying to enter the sports segment in an aggressive way. So it is Van Heusen is also trying to enter the jockey segment. Indirectly, it is trying to compete. If you see, they have outlets for sports. They have branded it also. I don't recollect the exact name. So similarly, it is possible that ABFRL like Raymond's. I don't possible that they may be doing also. Raymond's customizes their clothes also. They have a stitching unit also. They measure it. So I don't know what challenges. If ABFRL takes them heads on, then it could be trouble for them. So that's my small take.
What are the challenges and the threats for the company?
The challenges again today, both the brand ambassadors are powerful, but if you see Ranveer Singh with 83 not going, and so much I think was a certain brands is at stake, and Virat
Can't hear.
So your voice is very low, Krishnan sir. So cost high है, सब बहुत high है.
Am I audible now?
नहीं sir, नहीं.
I think till he comes back, we can look at some of the data the company shared in the RHP and also in the roadshows. The company talks about its performance against other key players across different consumer segments. Operating margins 43%, net profit margins 26%, ROC 41%. That is why they are talking about such valuations. And the companies, it is benchmarking itself and comparing, which is quite surprising, is Asian Paints and Titan also. And it says on margins and efficiency on all these three parameters is much more than Asian Paints and Titans and Levers and Dabbers. It's comparing itself with brands like Asian Paints and Titans and Levers and Dabbers.
Yeah, that is because they don't have any peer. Any peer company is not there now in this segment. I think this is the first company.
There are other peers, like it mentioned, Raymond's has a suite of shops. They are also into celebration wear. They also have a specially tailored products, but it is not focused on this segment.
नहीं, वो segment अलग है सर. Raymond का इसका segment में बहुत difference है. I think मान्यवर के जैसा कोई भी company, वेदांत फैशन जैसा कोई भी company इंडिया में listed नहीं है सर.
And it's interesting, you are looking at a market valuation of over 12,000 crores, right, Dushyant?
Yeah.
3,000 crore plus IPO.
Yeah, 3,000 crore IPO based on the market valuation of about 12,000 crore. But see, I mean, when we talk about the strength and weakness, is definitely the strength part. The biggest is that they have sustained the brand name. The thing is that there are so many local competitors. If you go to say Bombay, there are certain areas where you can get a variety of these kurta pajama for marriages and all. But then the local have the material, the appeal, the finish, all that they have been doing it very well. And because of this, so many shops they have opened. And once you go to a particular shop, the way the quality of the celebration wear, once you look at it, you will not like the wear at other places. That is the beauty of this particular brand.
That's interesting. Have you been to the store?
Yeah, many times. It's a lender of last resort. See, earlier I was to get the clothes stitched by my tailor and all. But now suddenly, when you don't have time to buy the cloth, then go to the tailor and all. Then, I went once to Manyavar. And then once I went and I was satisfied, I stopped getting it tailor-made myself. And my son also buys, youngster also buy. The thing is that each marriage, nowadays there are 3 or 4 functions. Like say Mehndi is there, then there is a Sangeet there, reception is there. And each function, everyone has to have 3 to 4 different types of, celebration wear. So at least two, suppose you buy from outside, 2 you get it stitched. But at least, that market is growing and nobody likes to wear the same clothes again in some other marriage. So that is what is working for them. And these youngsters, millennials with a lot of good salary, they like to spend on these things.
What is the price points at which you have purchased and you have seen the stock
It is
available?
something like it will be around 3,000 to 5,000 range, maybe more also. But
Okay, that's all.
Yeah,
You
3 to
get a
5,000.
good
You
maneuver
get a
product.
yeah, you get a reasonably good stuff.
And the price is also reasonable.
Yeah, I would say it's slightly more than normal. I mean, every store you go, you will get something like 20-25% cheaper, but then the quality and the finish has no match.
Okay, so they are offering value, a reasonable price, the right quality at the right time for the right customer, and not very exorbitant.
Yeah, and once you are used to kind of this type of this marriage shopping, then you will not go for stitched one, because the stitching part is buy the cloth, select the design, then give it to the tailor. The tailor may not do as per your design you want. And nowadays there are so many fashion conscious youngsters. They want a different unique style and things. So all these maneuver is able to offer to a great extent.
So what does the company store do? They offer you ready-made, or they stitch for you also? They can say
No. They give ready-made. They give ready-made.
They give ready-made, and then there is some alteration.
Alteration is always to be done.
Alteration is always there.
So what if you say you walk into the store and you say, I have time, I would like to get a suit stitched. Do they do that?
No.
Example, Manoj bhai, अगर आप जाएंगे मुझे एक शादी के लिए जोधपुर चाहिए.
Have you been to the store?
सर मेरा तो एक टेलर है 20 साल से एक ही है. मैंने अभी जोधपुर सिलवाया है.
Now we'll talking about Dushyant. You have been to the store and you say they have a size and a fit available.
Yes. There are plenty of designs available, and if it doesn't fit you properly, they'll do the alteration.
They'll do the alterations. That means they have got sufficient sizes and fits available, and it just requires a minor alteration. How much time the alteration takes?
Maybe in a day or two.
Okay, that's very, very fast. And sometimes you need urgently, they may give you on the same day also.
Yeah, maybe you wait for half an hour, 1 hour, they may give.
Oh, that's very interesting. And what you have mentioned, the price points are very affordable.
Yeah, and see, exclusive, that bridal and a groom kind of wear will be more costly.
So Manish, you have a choice now. You should go to the store and compare and see what's available, and what Dushyant's experience is, and also the family members, youngsters. They are happy with the quality. They are happy with the range of choice available. They are happy with the value offered. They get what they want, and you don't have to depend on a tailor, whether it's outside tailor or the company's store's in-house tailor also. You get a good celebration wear. And what the company says, how it became successful. They started joining hands with IPL. They contribute, gets associated with the offering their dresses to the IPL, and sometimes by attachment they get say the clothes by the brand. They often do it free, but it was a turning point in the company's fortune. It became very visible, and subsequently they are tied up with the femina contestants also. So they are changing their marketing strategy and getting associated with such events, whether it is in sports like IPL or whether it is in that for titles, Miss Femina, etc. So quite interesting. And again, in among the strengths, creating a brand, company has clearly articulated a strategy on pricing. It has gone for premium pricing and not been very successful. Then it changed to mid-premium pricing. Otherwise, premium pricing, you can say a person is going for a store and he pays upwards of 10,000. But no, as you said, 3,000 to 5,000 products. So they have gone in for mid-premium pricing, and also articulated different strategies in different years.
No, Manoj, what I'm saying, this 3,000 to 5,000 is for, suppose as not a family member of the person in whose family the marriage is there. If the groom goes, or the immediate family members of the groom, for them there will be definitely costly upper range, premium range is there.
Right.
Yeah.
I like example. I tell you, Dushyant bhai, the Jodhpuri I got stitched from my tailor. It is around 3,000. If I go to Manyavar, it is not less than 7 to 10,000.
How many days it got for you to do from the personal tailor?
10 days.
Okay, so there are this is a large market available, unorganized, and
Dushan bhai, rather I tell you there are three kind of people. One is
Manish,
like
Manish, are we talking about it? Have you been to the Manyavar store?
Yeah, my friend was having the one good store in Borivali.
Okay.
7-8 years back. So we had a lot of talk. What Dushan bhai says is correct. आधे घंटे में भी alteration करके मिल जाता है आपको. There is no issue.
So what was the problem in the Manyavar store? Did they did not offer you the product you wanted, or the price was different, or it was
No,
a timeline?
I have like very precisely. I have my friend who's having a shop in Malad for many years. So I stitch my clothes there only.
Yeah, but we are talking about Manyavar when you made a visit. What was your experience in the store as a customer? What was the experience?
As a customer, it's good actually. It's a exclusive kind of thing. If Manyavar one should go only, there is a marriage in family only. Then that value for money is there.
Celebration wear. They are tagging themselves as a celebration wear now.
Yeah.
Even IPL victory is a celebration, and even watching the Femina contest and win the prize itself becomes a celebration.
Definitely, it's a very, very exclusive showroom, no doubt about it.
But the two negatives are, one is that it is OFS fully, 100%.
Yes.
And the valuation, I would say, is a bit cheap, even though the profitability is good and all that. But, the company comparing it with, say, MNCs or maybe for Titan and all is slightly, I would say, is more ambitious.
Ridiculous or ambitious. It's interesting.
Ridiculous, correct.
Asian Paints and Titan. But it shows to the vision of the promoter and whoever it is instigated by, whether the private equity players, but hopefully that trust of the brand and the consistency is very, very important. And Asian Paints and Titan have created a consistent shareholder value. So integrity in reporting, sustainability, and also regular interaction with stakeholders is very, very important.
Yeah, but the what do you call the winning, what do you call their uniqueness is that Asian Paints and Titan, they have been innovative, constantly, and offering new products to the various types of customers. And their product offerings are also varying quite a bit. Now, here in case of Manyavar, I think if the marriage and celebration, if they limit to that, then possibly they will stagnate at some point of time.
इसमें भी बहुत fashion change होता है.
No. They're only banking on the fashion change and the human psychology, that nobody wants to wear the same cloth again in the family marriage or some close friends marriage. So they will have a repeated buying market from the same customer. The repeat market will be there. But then after some time, when you have some 8 or 10 pair of clothes, then you think, okay, let me now go, wear the first one which I bought before 2 years. So some kind of market stagnation may come, maybe not now, but later on. But the only thing is the youngsters, the way they are spending and the way they are celebrating the marriage, I think that to the great extent will be helping them.
Generally, तो ये clothes आप एक ही बार पहन सकते हो, maximum. And maximum 2 times.
Talking about peers, we talk about comparison which the company is doing. These other companies are also in affordable prices. Titan, Asian Paints, Dabur, Lever, they are also in affordable prices. They are not in premium or mid-premium segment. So the volume also is very, very important for point of view of growth. On a low base, Titan is small number of franchises, 50, 70, 100, 150, 200, 300. On a small base, it is easier to grow. But on a large base, ultimately, the category needs to be redefined. So then one can become a volume player. And for becoming a volume player, of course, the market is huge, but then you have to go into affordable segments also. And affordable segments person looks at the price of the product and the value and competition. He goes to 5 different shops possibly. So in that case, margins become reasonable, and in that case, valuations also different. So this has an advantage, as we said, it is richly priced, but it has an advantage of high growth numbers, which are talking about high growth and high operating margins, very high ROC. Whether ROC of 41% can be sustained is to be seen. If it doesn't sustain, if it comes down by half, then the valuation can come down to, it can come down by over 60%. And the growth also, of course, in growth, pandemic, it has been challenged. Now market is opening up, so possibly 23, 24 growth may be much higher, and maybe the valuations it is pricing in. Anchor is yet to open next week. We'll need to wait and watch the type of anchors the company gets, whether it is quality mutual funds or whether it is hedge funds. But ultimately, Kedara Capital AIF is selling a significant part of the stake. So quite interesting. So lots of strengths in the company, the management. They had talked about the profile of the KMP also. The CFO has experience with ENY. Although the promoters are just graduates, they got a very good professional team, very high level of management and modern practices, technologies being used, latest fashion. So it shows the vision and growth of the promoter. In fact, it's surprising. The company in this presentation is talking about ESG practices also. Now, ESG and sustainability is a buzzword, but it's all jargon. The presentations are done by the top management team in the roadshows. But very vital issues on the segment, mass segment, and volumes and EBITDA and ROCs, whether they can sustain and continue growing at a higher rate. Of course, the strategy would be redefined, hopefully after the IPO. But it's quite wait and watch. It is good such Indian brands are coming. It's a matter of pride for India. India growth story. Earlier, it used to be foreign brands. People used to say, this is a foreign brand, European brands or American brands. An Indian brand getting high valuation, particularly in the apparel thing, is quite interesting. So can we request now Dushyant to give the final vote of thanks to the excellent proceedings we had during the day?
Yeah. Dushyant bhai.
Dushyant bhai, I hope your video is on. Or is there some network issues?
Probably.
Dushyant? Manish, you can do the final vote of thanks for the excellent proceedings, excellent knowledge sharing we had during the day.
Today we had a very good session from Vivek Mavani. He has given a very good presentation, and there were very good, remarks from Sanjeev bhai. He has given a lot of new things to understand what is the perspective to see the valuation of the company. So both Vivek and Sanjeev ji both have given us tremendous knowledge today about capital market. And as usual, we are doing IPO. So we have done a analysis of 2 IPOs, Adani Wilmar, as well as in Vedant Fashion also. So thank you everyone for joining today, and have a nice weekend. So with this, we are ending our today's session. Happy weekend to everyone.
Happy weekend to you also, and good presentation by you also.
Thank you.
Thank you.